the CPR indicator was kept hidden by many experienced traders in India. There are many legendary traders in India who appear in TV channels, who appear in newspapers. Many legendary traders are there who are using CPR and moving averages, but they will never reveal the truth. So I was the first person to speak out about the CPR, which is a very good price action indicator. CPR is a price action indicator and moving average is also a price action indicator. That is what which we are going to see now. So as soon as I spoke about the CPR in YouTube, I started getting many followers because this was a very new concept for everybody, which is actually working in all the markets. Even in my course material, I have mentioned CPR by kg, a signature course for NSE, NFO, MCX, CDX, and Forex. You can apply this CPR and moving average tricks everywhere. Everywhere you can apply this CPR and moving averages. So I started my trading in 2014. When I was in my college days, in 2014, I entered into stock market. And now this 2020 is my 6th year in my trading career. Okay, so initially I started trading and I was like other people. Okay, everyone who step into stock market will be losing money, right? So I was also losing money at the beginning. Okay, I used to trade during my college days. I used to bunk the classes. I used to trade, and during the classes also I used to take the trade using my mobile phones. Okay, so I was losing a lot of money. I used to tell lies to my parents. I used to get many money from my parents. Like I used to tell I need to pay hostel fees. I need to pay mess fees. I need to pay for a project. I'm doing mini project like this. I used to tell many lies to my parents, and I used to get money for trading. So whichever money they put in my bank account, I used to transfer to my trading account, and I was taking the trades and I was losing the money. As time goes by, I realized that there is something there in this field. When others are making profit, when people are making money in Twitter, when people are making money in WhatsApp, when people are making money in Facebook, why I am unable to make money? And then I realized that stock market is also a subject. I need to learn that first. After that, I attended many training programs. And through experience and repeated trading, one thing which I will tell is, even though if you are strong in technicals and if you are not having any trading experience, then definitely you will not succeed. You need technical experience, you need technical analysis knowledge, as well as trading experience. You should trade every day. You should practice trading every day. Only then you will know where you are making the mistakes. Okay, some people, they will tell, I know technical analysis, I know everything, but I am not making profit. So some people, they don't know anything about technical analysis and they will be losing money. Okay, we cannot change people like them, but there are many people who know everything about technical analysis, but they are still unprofitable. The reason is lack of trading experience. You need to trade every day. You need to trade regularly. So trading using indicators is very easy. If I am telling you to use super trend, if I am telling you to use RSI, Bollinger Bands, MACD, it is easy to take the trade. Okay. When you use indicators, you are not following the candles. Okay. When you use RSI, you forget to see the candles. You will be checking whether RSI is going to overbought or oversold. When you use super trend, When you use super trend, you will be checking whether I am getting buy signal or sell signal. In that way, you will miss out the message given by the candles. So indicators will never help you in a long run. That's why I designed this course for price action, where we will be discussing about CPR and moving averages. I have trained more than 300 people all around the world. I have students from US, UK, New Zealand, Australia. Many Indians who are staying abroad, they have attended my training program. So everyone knows about my teaching style through my YouTube videos. I'll be teaching in a very simple English so that even a school student can understand. My motive is everybody should understand. If I am teaching one concept, 30 people are attending my webinar, all the 30 should understand. That's why I use very simple languages, very simple examples I use while teaching. So that's all about me. So I am a trading mentor in a few brokerages, and I used to give regular seminars and guest lectures in colleges. And I am a full-time trader, and I am the founder and CEO of Scalper's Trading Academy. I am basically from Chennai. I am basically from Chennai, Tamil Nadu. So that's all about me. I am 25 years old. So good morning, everybody. So let's kickstart to the session. So you are all watching my screen. So these are the topics which we are going to see today. Okay. So initially I will be covering some basics about futures and options. Okay. Like what is futures, what is options, introduction to derivatives trading. Okay. Like option chain, option buying versus option selling. So up to this topic, it will be a little basics. It will be a little basics. Our core concepts will be discussed in the later part of the session. This is the core subject of our today's webinar. Okay. So this little basics will not be boring. So you don't need to worry. I just want to know how many don't know anything about futures and options. Those who are new to futures and options, please tell me yes. If you don't know anything about futures and options, tell me yes. If you know about futures and options, you don't want to send me any messages. You can sit simply. You can simply sit comfortably. So if you don't know anything about futures or options, type yes. Okay. So many people are new to futures and options. Okay, so many people don't know about futures and options, and few people knows about futures. They don't know about options. Few people are there who knows about options, but they don't know about futures. So no problem. We will discuss the basics of futures and options. See, remember, I will not tell in depth about futures and options, because futures and options is like a book. It is a whole new concept. Okay, so we cannot discuss futures and options within one day. It takes a lot of time. It needs a lot of attention. It needs a lot of practices also. So I will be telling some basics about futures and options, okay, which is enough to understand about futures and options, okay, which is enough to understand about futures and options. So these are the people who are the pillars behind my trading success, okay. And I have told this even in my YouTube videos. I follow Oliver Wells, Frank Ochoa, and Ashwani Gujral. So first we are going to see about the classification of derivatives trading. Okay, classification of derivatives trading, how the derivatives market is classified. Okay, you all know that futures and options are derivatives market. Okay, futures and options are called as derivatives market. Okay, see, from Apple, what we will get from Apple, I get apple juice, right? Okay, from Apple I am getting apple juice. Similarly, from a particular stock like TCS or Infosys or State Bank, anything from a particular stock called TCS, I am deriving futures and options. I am deriving futures and options. It's very simple, like deriving. It's like getting an apple juice from Apple. Okay, we are getting futures and options of every stock from that particular stock. From TCS, I am taking TCS futures. I am taking TCS options. Okay, so futures and options are derived directly from that particular stock. If you are taking Nifty is an underlying asset. These stocks, index, and commodities are called as underlying asset. Okay, so index, if you are taking Nifty, from Nifty we are taking Nifty futures, from Nifty we are taking Nifty options. This is called as derivatives. We are deriving from the underlying asset. These futures and options are derived from the underlying asset, so they are called as derivatives contract. They are called as derivatives market. In this derivatives market, there are two types. In this derivatives market, there are two types, and the two types are futures and options. The two types of derivatives market are futures and options market. Okay, this futures market is similar to equity cash. This futures contract is similar to equity cash. For example, in TCS, you will be buying one share or two share or 5 shares or 10 shares. Okay, you can buy any number of quantities in TCS, in cash market, in equity cash. But if you are buying TCS futures, you can buy in predefined quantities. For example, the quantity is fixed. For example, Nifty is having a quantity of 75 quantities is there in Nifty. In Bank Nifty, there are 20 quantities. So you cannot buy one quantity, you cannot buy two quantity. Okay, the quantity is fixed. In the multiples of those quantities only you can buy. For example, if TCS is having 1000 quantities, you can buy in multiples of 1000 only. You can buy in multiples of 1000 only. You cannot customize and buy 100 shares, 200 shares. Okay, so you cannot buy as you wish. Similarly, for options also, you can buy in predefined quantities only. Okay, you can buy in predefined quantities only, and in options there are many types like call option, put option is there, that we will see in later part of the slides. So in this slide, which point you should take is futures and options are derived from equity cash. Okay, from stocks, from index, from commodities, we are deriving futures and options. And futures is similar to equity cash with predefined quantities. Options is also having predefined quantities similar to futures, but options is a totally different concept which we will see in the later part of the slide. Now we are telling about futures, we are telling about options. Okay, I'm telling predefined quantities. Okay, futures and options. Why this was introduced? First, you should understand why futures and options are introduced. I can buy 5 shares, I can buy 10 shares in equity cash, right? I can buy 100 shares, I can buy 200 shares as I wish. But why futures and options are introduced? Why futures and options are introduced? See, futures and options are introduced for hedging purposes. What is hedging? For example, from stocks, from index, we are getting futures and options. Now, why these futures and options are introduced? For hedging. For hedging, which is used by FIIs and DIIs. Now, what is hedging? Okay, I am telling futures and options are introduced for hedging purposes. What is hedging? I will tell you now. For understanding hedging, what is hedging? I will tell you a simple example. See, you are buying a house. Okay, you are buying a house. For example, the cost of that house is 30 lakh rupees. You are buying the house on monthly installments. Okay, you have to pay the monthly EMI for that particular house. Every month you need to pay 15k or 20k. Okay, now for paying the monthly EMI, what you are doing, you are renting your house. You are renting your house. For example, in ground floor there is 2 BHK, and in first floor there is 2 BHK. Now what you are doing, you are leaving the ground floor for rent, and the rent amount is 15k, and in the first floor you are staying with your family, and in the first floor you are staying with the family. So from the monthly rent which you get from the ground floor, you are paying your monthly EMI. So the money from rented house, okay, you are renting the ground floor for 15k. Every month the monthly rent is 15k, and using that 15k you are using that money for paying the monthly EMI. Okay, this is called as hedging. This is called as hedging. Simple example for hedging. I will tell once again. You are buying ABC shares. For example, you are buying TCS shares. Okay, you are buying TCS shares, and there is a sudden loss for TCS company. There might be any bad news. Okay, the TCS company may not perform well. The TCS company MD might resign the job. So there are many possibilities. Okay, so when there is a temporary loss for TCS, what happens? The company share price will decrease. The company's share price will decrease. So now what you can do, you can buy, you can take counter position in futures and options. You can take counter position in futures and options, and from the profit you get from futures and options, you can compensate the losses made from equity cash. See, this is TCS company. One share price is 1000 rupees. Okay, you are buying 1000 shares. Okay, you are buying 1000 shares. So what is the cost? So you are buying TCS shares for 10 lakh rupees. Okay, so your total investment is 10 lakh rupees. Now there is a bad news for TCS. There is a bad news. Okay, the result might be poor. TCS might deliver a poor results, or there might be a legal case. Okay, like this, there is some bad news for TCS company. Now what happens? This one share price of TCS will go down. This one, now what happens? The share price of TCS decreases. So what happens? One share will become 800 rupees. 200 rupees will go down. Okay. Now what happens to your portfolio? You are having 1000 shares. Okay. Now your portfolio becomes 8 lakh rupees. Your portfolio becomes 8 lakh rupees, and now you are in a heavy loss of 2 lakh rupees. Right? You are in a loss of 2 lakh rupees. To compensate these losses, what you can do, you can take counter position. You can take counter position in futures and options. You can take counter position in futures and options. How to take counter position? You can sell in futures. You can sell TCS in futures. Okay. You can buy put option. You can buy put option, and similarly you can sell call option. Like this, you can take many counter position. From this counter position, you will be getting some amount of profit. Some amount of profit like 2 lakh rupees or 3 lakh rupees. Now this profit is used for compensating the losses in equity cash. This is called as hedging, and this is used by FIIs and DIIs. This is used by FIIs and DIIs because FIIs and DIIs, they will be investing in mutual funds. You all know about mutual funds. Okay, FIIs and DIIs, mutual funds are, they come under the category called DII. I will show you one mutual fund. See, this is Kotak Standard Multi-Cap Fund. Okay, this is Kotak Standard Multi-Cap Fund, and see the amount which this fund is having. See, this Kotak Standard Multi-Cap Fund is having a huge amount of 30,000 crores. This one mutual fund is having 30,000 crores in their portfolio. Now I am going to see where this 30,000 crores is invested. Where this 30,000 crores is invested in each and every company. This 30,000 crores is invested in each and every company, and these are the top 10 stocks. See, this Kotak mutual fund is having ICICI Bank, Reliance Industries, HDFC Bank, L&T, Axis Bank. Like this, they are having very good companies, top 10 stocks. Now look at the quantities they are holding. Look at the huge quantities which Kotak mutual fund is having. See, this Kotak mutual fund is having a huge number of quantities. In ICICI Bank alone, they are having 4 crore shares. In ICICI Bank alone, this Kotak mutual fund is having 4 crore shares. Okay. Now just imagine if there is a sudden bad news for ICICI Bank. Just imagine there is a sudden bad news for ICICI Bank. See, in ICICI Bank, this Kotak mutual fund is having 4 crore shares. Okay, let's assume one share of ICICI Bank is 500 rupees. So, Kotak mutual fund has invested 2000 crores in ICICI Bank. Okay, they have invested 2000 crores in ICICI Bank. Now there is a sudden bad news in ICICI Bank. Now there is sudden bad news in ICICI Bank. Now what happens? This ICICI share price will decrease from 500 rupees to 400 rupees because of bad news. Because of bad news. Now what happens? The share price will decrease. The share price will decrease, and now the portfolio becomes 1600 crores. Now the portfolio becomes 1600 crores, and now they are in a loss of 400 crores. This Kotak mutual fund is now in a loss of 400 crores. So now what happens? This loss is not bearable by the mutual funds, right? This is a very huge loss. This is a very huge loss, and this loss is not bearable by mutual funds. So what they will do, they will take counter position in futures and options. They will take counter position in futures and options. So what they will do, they will short in futures, they will buy put option, and they will sell call option. These 3 counter position they will take, okay, and now they will make profit from this counter position. They will make around 400 crores profit from this counter position, and this profit is used for compensating the losses made from equity cash. So the profit made from futures and options is used for compensating the losses made in equity cash. This is called as hedging. This is called as hedging. Okay, that's why I told hedging is predominantly used by FIIs and DIIs. See, FIIs and DIIs are investing in Indian companies. They are investing in Indian companies, and if the Indian company is making losses, what will happen? Nobody will come and invest in India. Foreign companies are investing in India. See, Amazon is investing in India. Okay. Many foreign companies are investing in India. If all the foreign companies are making losses in India, what will happen? Nobody will invest in India. So, even though if the company is making losses, there should be some alternative for recovering the loss. For that alternative only futures and options are introduced. For that alternative only futures and options are introduced. And as I told earlier, see, futures and options are a contract. It's like a monthly rental contract. Okay, like monthly rental contract or yearly rental contract. So futures and options are a contract, they are having expiry. Every month futures and options are having expiry. Okay, because it is a contract. Okay, it is a contract. Futures and options are a contract. Every month there is an expiry. It's like a mobile data pack. Okay, if you are recharging for your mobile data, the validity is 28 days, right? Similarly, futures and options are also like a contract. It is having a validity of 28 days only. And this is the small example which I told. This is the small example which I told for you for easy understanding. Okay, this is called as hedging. Now, do you all understand the concept of hedging? Why futures and options is introduced? If you understand, just type yes or why or yes. Did you understand what is hedging? Why futures and options are introduced? Do you all understand? It is easy, right? Yes, Narasimha Murthy, ask the question. You are having one question, right? Ask me. I guess everybody understood what is hedging. If you have any doubts regarding hedging, you can tell me now. Otherwise, we can quickly go to the next concept. Narasimha Murthy, you can ask the question. See, Narasimha Murthy, you are having 1,000 shares. Narasimha Murthy, why we should take counter position in futures and options? It is very simple. Okay, see, you are having 1,000 shares of Reliance. You are having 1,000 shares of Reliance. You are having 1,000 shares of Reliance. You know, Reliance is a very big company, Ambani company, right? Ambani is the number one richest person in India. Ambani is the number one richest person in India, and you are having 1,000 shares of Reliance Industries. Now, what happens? Now, there is a sudden bad news. Now, there is a sudden bad news. They are going to arrest Ambani. Okay, this is just an example. There's sudden bad news and they are going to arrest Ambani. Now what happens? Let's assume the share price of Reliance is 1,000 rupees. Now, as soon as the news comes, they are going to arrest Ambani. What happens? This 1,000 rupee share price of Reliance will come down to 600 rupees or 700 rupees. Okay, because it is a very huge bad news, right? He is the number one richest person in India. He is having the world's costliest house. Okay, he is having the world's costliest house. So he is a very big giant. So if there is a bad news and if they are going to arrest Ambani, surely the share price of Reliance Industries will go down. Okay. So what happens? You are making losses. You are in a loss of 4 lakh rupees or 3 lakh rupees. You are having 1,000 shares. As soon as the share price goes down, you are in a loss of 3 to 4 lakh rupees. But we all know that Ambani is the richest person. He is very powerful person. He will get bailed immediately. He will come out very easily. We all know. So what happens? Once again, the Reliance Industries will jump to 1,000 rupees. Once again, this Reliance Industries will jump to 1,000 rupees or 1,500 rupees because he will get bail very easily. He will get bail very easily. Okay. So what you will do, you will not sell. You should not sell because Reliance is a very good company. You should not sell 1,000 shares out of panic. Since Ambani is arrested, you should not sell 1,000 shares. Okay, out of fear, you should not sell. What you can do, you have to take counter position. Okay, you have to take opposite position. You have to take opposite position by selling futures. By selling futures or buying put option. Okay, if you are selling in equity cash, the shares from this 1,000 shares will be deducted. Okay, for example, if you are going to short Reliance, you should not short in equity cash. If you are shorting 1,000 quantities in equity cash, what happens? This will be sold. Your holdings will be sold. So you have to take counter position in futures and options only. You can take counter position in futures and options only. If you are selling in equity cash, what happens? Your holdings will be sold. That's why we are taking counter position in futures and options. Narasimha Murthy, did you understand now? If you are selling 1000 shares, what will happen? Your 1000 shares will get deducted. So only we are taking opposite position in futures and options, because futures and options is a contract. Kiran, your question is not clear. Kiran, your question is not clear. You can ask me a little clearly. So Praveen Kumar, what happens if the price goes back to where it is? See, if the price is going back to the same 1000 rupees, now your portfolio will be in profit, right? Your portfolio in profit, and you have to immediately exit futures and options. That much experience you should have to analyze when to take counter position, okay, when to exit the counter position. Those comes upon experience and rich technical knowledge. Now for easy understanding, we are telling take counter position in futures and options, but practically it is very difficult. Okay, this is just a basic thing to understand how to take what is a hedging and how to take counter position. So next we will see about futures trading. Now what is futures trading? Everybody is telling futures, futures, futures. What is futures? See, futures is very simple. Futures was introduced by seeing forward contract. Okay, see, there was a forward contract. What is forward contract? See, forward contract is a type of contract where two persons is directly involved. See, here two persons are directly involved. Contract made directly between two persons. For example, I am getting 1 lakh rupees from you. Okay, Gomati Shankar is getting 1 lakh rupees from you. Okay, now what happens? I will repay this 1 lakh rupees after 1 month. I promise that I will repay this 1 lakh rupee after 1 month. Okay, and you also gave me 1 lakh rupees. Now what I will do? I will escape. I will escape without paying this 1 lakh rupee. I will escape without paying this 1 lakh rupee. So what happens? You are losing 1 lakh rupees. I am cheating you, right? This kind of risk was there in forward contract. This kind of risk was there. Counterparty risk. This is what they tell us counterparty risk. Somebody will escape. And the contract is made directly between two persons. The contract is negotiated between two persons directly. So there is a possibility of risk in forward contract. Now what they did, now they changed this into futures contract, and it was totally organized through exchange. Who is organizing this contract? NSE is organizing this contract under the regulation of SEBI. Under the regulation of SEBI, NSE is regulating this contract. Okay, so now from whom you are buying, you don't know. From whom you are selling, you don't know. Okay, you don't know anything. You don't know the buyer and seller. For example, if you are buying TCS futures, you don't know from whom you bought. Similarly, if you are selling TCS futures, you don't know who is the buyer. That much organized contract was made by NSE. So futures contract was introduced from forward contract only. Since it is regulated by the exchange, there is no counterparty risk. Nobody can escape. Okay, nobody can escape. Everybody have to pay the margin, and then only they can buy. So now the contracts are made very risk free. In futures, there are three technical words which you should never forget. These 3 points are very important in a futures contract. Okay, if futures price is lesser than spot price, we call it as discount. And if the future price is greater than the spot price, we call it as premium. And on the day of expiry, everybody know futures and options are having expiry. I told you already, futures and options are having an expiry. Okay, on the day of expiry, what happens? This futures and spot price becomes equal. For example, if equity price is 100 rupees, futures price also becomes 100 rupees on the day of expiry. On the day of expiry. Other days, futures price may be greater than the spot price or may be lesser than the spot price. If it is greater, we call it as premium. If it is lesser, we call it as discount. This is the small basic thing about futures trading. Now we have to know who are all participating in futures and options. Now that's all. We completed futures trading. Okay, so futures contract was introduced based on forward contract, and futures contract you can buy in predefined quantities only, and futures contract is regulated by the exchange. Nobody can escape in futures and options contract. Okay, and there are some technical points. These 3 points we discussed just now. Now, who are all participating in futures and options? In futures and options, hedgers are participating. You all know FII and DII. Who is FII and DII? They are called as institutional players. They are called as institutional players. They are having more than 1,000 crores money. They are having 1,000 crores money. They are having up to 5,000 crores money. Okay, they are playing with huge amount. They are playing with huge amount, so they are called as hedgers. Now, who are these? Are the first category. Now, who are speculators and traders? See, we are speculators. We people, we traders are called as speculators and traders because we will buy and sell as we wish. We will be buying, we will be selling, we will be doing all sort of things. We are called as traders, we are called as speculators. Now, who are called as arbitragers? There are few people called as arbitragers. This arbitrage is also done by institutional players only. This arbitrage is also done by institutional players only. Now, what is arbitrage? Arbitrage in futures, you can do arbitrage in futures. What is arbitrage? It is very simple. I told you on the day of expiry, on expiry day, futures and options becomes, futures and equity cash price becomes equal. Equity cash price becomes equal to futures price. Other days, what happens? On the other days, both the price will be different. Both prices will be different. For example, equity cash price will be 100 rupees and futures price will be 110 rupees. Now, this arbitragers, what they will do, we all know, this is a very important point, don't forget. We all know equity cash and future price will becomes equal on the day of expiry. On expiry day, it becomes equal. Other days, the prices will be different. Now, we are taking one example. Cash price is 100 rupee and future price is 110 rupee. Now, what arbitragers will do, they will buy 1,000 shares, or let's keep 10 shares. They will buy 10 shares in cash market. Okay, they will buy 10 shares in cash market. So the total investment is 1,000 rupee. Now they will sell 10 shares in futures. They will sell 10 shares in futures. Okay, so this is the total investment amount. So what happens if on the expiry day, if both the prices goes to 90 rupees, okay, what happens? Here they will be making a profit of 10 rupee, right? Here they will be making a profit of 10 rupee, and sorry, here they will be making a loss because they are buying, right? So they will be making a loss of 10 rupee. Same here, they will be making a loss of 10 rupee, and here they will be making a profit of 20 rupee because they are selling, right? Here they are buying. So here they are making a loss of 10 rupee, here they are making a profit of 20 rupee. So now if we calculate this, we are in a total profit of 1000 rupee, okay, which means we are buying 10 shares, right? So we are making a profit of 1000 rupees. So you are clear, right? This is what arbitrageurs will do. This is what arbitrageurs will do. This is the role of arbitrageurs. Okay, they will be buying in cash market and they will be selling in futures market, or they will be selling in cash market, they will be buying in futures market. On the day of expiry, both the prices will become equal. Both the prices will become equal. Let's assume they are buying one share and they are selling one share, they are selling in futures. On expiry day, if both the prices goes to 90, what happens? This buying will be in a loss of 10 rupee and this selling will be in a profit of 20 rupee. So overall, what is the profit? 10 rupee. See, this is called as arbitrage. This is called as arbitrage. So these are the three type of participants in futures and options market. And this is how we call the type of contract. There are three type of contracts. There are three type of contract: near month contract, next month contract, and far month contract. Near month contract means the current month. Now the current month is February, so it is called as near month contract. The next month contract is March, and the far month contract is April. These are the 3-month contracts which are available for trading. When the February month contract is over, automatically May month contract will be opened. Automatically May month contract will be opened. This is called as type of contracts. Now we are going to see about options. So far we completed about futures. Okay, we saw about the classification of derivatives trading. In classification, there are two types: futures and options. Okay, and why futures and options are introduced? For hedging purposes, I told. For taking counter position, futures and options are introduced for hedging purposes, I told. And we saw about futures trading. Futures trading is similar to forward contract. Okay, and in futures trading there are three technical points: discount, premium, and on expiry day both futures and spot becomes equal. Futures contract is regulated by NSE, and there are three type of participants in futures market. The three type of participants are hedge fund managers, speculators, and arbitrageurs. Okay, and there are three type of contract both for futures and options. There are three type of contract: near month, next month, and far month. Now we are going to see about options. Okay, now we are going to see about options. See, options is like buying an insurance. Okay, options is like buying a health insurance. Why you will buy a health insurance? Because we will think some medical emergency may come for us, right? In future there might be some medical emergency, so we will buy insurance, health insurance. So what is options? Options is like a health insurance. Now option buyer. Who is option buyer? An option buyer is like a health insurance buyer. And who is a option seller? Option seller is like a health insurance seller. Option. Who is a buyer? We are buyers. We are option buyers. And who is a seller? Let's keep LIC or Religare. Okay, you can take any health insurance, Religare or ICICI Lombard insurance. There are many types of health insurance. Okay, so we are buying health insurance. From whom we are buying? From LIC or Religare or ICICI. So what we do? So what we are doing, every year we are buying health insurance. Every year, for example, we are paying a premium of 10,000 rupees every year. And if suppose there is any medical emergency, we will be getting a coverage up to 5 lakh rupee or 10 lakh rupee. Right? And every year we will be paying 10,000 rupees. Every year we will be paying 10,000 rupees. Now, assume 1 crore people are buying. Assume 1 crore people are buying health insurance. Okay. So just imagine 1 crore people are paying 10,000 per year. So just imagine how much money this LIC are getting. This LIC or health insurance agents are getting. They are getting a huge amount, right? But in practical, are the 1 crore people going to hospital? In practical, are the 1 crore people going to hospital? No, right? Among this 1 crore people, only 10,000 or 20,000 people will be going to the hospital due to any emergency. Okay. So from 1 crore people, they are collecting 10,000 crores. From 1 crore people, they are collecting 10,000 crores, and only 10,000 people or 20,000 people will become ill. Okay. But, and only 10,000 or 20,000 people will become ill. So what happens? If they are paying money for those family, only few crores will be spent. Only few crores will be spent, and the remaining amount is profit for LIC and health insurance agents. Okay. For the remaining people, what happens? For the remaining people, it is a loss. This 10,000 is loss for us, right? For example, I am paying 10,000 rupees every year. I am paying 10,000 rupees every year. Okay. For 30 years, I am buying. Okay. And still I am very healthy. I am very healthy. So now this total amount which I paid for 30 years is a loss for me, right? It is a loss for me because I am healthy. Okay. But if suppose something happens for me, okay, I am just paying 10,000 rupees, and if something happens for me or for my parents, okay, or for my spouse, anything, if something happens, with this just 10,000 premium, I am getting a coverage up to 5 lakh rupees and 10 lakh rupees. Okay. So this is how options work. This is how options work. So see here, option buyer is like a insurance buyer. Okay. And option seller is like an insurance seller. Okay. See, I am afraid that something will happen for me. Okay. And my hospital bill may be in few lakhs. Okay. So this LIC agent, what he will do, he will collect 10,000 rupees and he will take care of me. Okay. He will take care of me. So what is the mindset of an option seller and option buyer? Now in this case, we are thinking LIC as our option seller. What is his mindset? He will think we will not go to hospital. Okay. And the probability of going to hospital is very less. Okay. And he is selling a lot of policy. Okay. He is selling health insurance for crores and crores of people. Okay. And only few people are getting hospitalized. So only small amount he is going to lose. Okay. But what is the option buyer mindset? Most probably I will not go to hospital. But why to take a risk? I don't want to take any risk. If I am going to hospital, my expenses will be high. So let me pay a small price. That's why he is paying a small price. Okay. And see, option selling versus option buying. Okay, if all the 1 crore people are falling ill, what happens? It is a loss for the option seller. Option seller means this LIC agent. Okay, and there is a small profit only for option seller. For example, he is getting only 10,000 every year. Okay, and there is less chances for him for making losses, and he makes profit in most of the time, but we are making losses in the long run. Now I will tell you in terms of options. Okay, what is call option? Call option means if you are bullish in market, if you think market is going to go up, you have to buy call option. If you are going to buy options, you have to buy call option. If you think market is going to go down, what you have to do? You have to buy put option. Okay, whether market is going up, whether market is going down, you have to buy call option or you have to buy put option only. Okay, we are not option seller, we are option buyer only. So if market is bullish, what you have to do? You have to buy call option. If market is bearish, what you have to do? You have to buy put option. Okay, why we are buying option? Okay, we are just buying an option, just like buying a health insurance. We are buying options just like an health insurance. Okay, if option price goes up, see, I'm bullish in market and I am buying a call option, and similarly if market is going up, I will be making profit. For example, I am buying 300 call option from State Bank of India. Okay, and if State Bank of India goes above 300, see, I will be making profit. See, State Bank of India is going up, and see, I am making profit. 1 rupee, 2 rupee, 3 rupee, 4 rupee, 30 rupee, and 60 rupee. And now the option seller is making losses. Okay, because I am buying option, so I am making profit. So the opposite person who is selling will be making loss. Similarly, I am buying 300 put option. So if market goes below 300, I will make profit. If market goes below 300, I will make profit. See here, market is going below 300, 299, 298, 260. So I am an option buyer. So I am making profit of 1 rupee, 2 rupee, and 40 rupee. Now what happens? The opposite person who is an option seller, he will be making losses. Clear? This is what happens in a buying an option. So buying an options is like a health insurance. In the long run, option buyer is not profitable. Option seller is profitable. Okay, option buyer is profitable only in the short term. For example, I am buying health insurance for 10,000 rupee. Okay, per year I am buying health insurance on 2020 February. Okay, if suddenly there is some medical emergency for me, okay, there is a medical emergency for me in the month of June or August. Okay, in the month of June or July, if there is any medical emergency, okay, what happens? My medical bill will be 2 lakh rupee or 3 lakh rupee or 5 lakh rupee. Okay, but I don't need to worry. Why? Because I am having a health insurance, and this LIC will pay the money for me. Whether it is 2 lakh, whether it is 3 lakh, or whether it is 5 lakh, LIC is going to pay money for me. Okay, but I paid only 10,000 rupees. But LIC is paying me 3 lakh, 5 lakh rupees as hospital bill. So in short term, option buyer will be profitable. But in long term, option buyer is not profitable. Okay, and this is a small example for call option and put option. If you are buying call option, market should go up. If you are buying put option, market should go down. Okay, and whenever you are buying, see, you are buying a health insurance by paying 10,000 rupees, right? Similarly, if you are going to buy call option, if you are going to buy put option, you have to pay a premium. You have to pay a premium. Okay, that premium might be 10 rupees or 20 rupees, any amount. Okay, and if market is going up, what happens? You will be making profit. See, call option buyer. I am buying 300 call option. I am buying 300 call option, and if market goes to 360 rupees, okay, I am making 60 rupees profit. I paid a premium of 10 rupee, so 60 minus 10, 50 rupees profit for me. But for option seller, see, this is an option seller. For option seller, 50 rupees loss. Okay. Similarly, for put option, I am buying 300 put option. I am telling market will go down. I am buying 300 put option. If market is going to 260 rupees, I am making 40 rupees profit. I am paying a premium of 10 rupee. So 40 minus 10, 30 rupee profit for me. And for option seller, 30 rupee loss. So this is how option work. If I am going to buy an option, I should pay a premium amount, just like buying a health insurance. Okay. If I am buying a call option, I have to pay a premium. If I am buying a put option, I have to pay a premium, just like buying a lottery ticket. Just like buying a lottery ticket. Okay. You will buy a lottery ticket for 100 rupee or 200 rupee, but your prize money will be 1 crore or 2 crore. Same way. If I am buying a call option, I have to pay a small amount. And if the market goes up, I am winning the match. Okay. If I am buying a put option, market should go down. If market goes down, I am winning the match. Okay. So this is the general thing about futures and options, call option and put option. Okay. And another one important thing, options is like an ice cream. Options is like an ice cream. For example, you are buying an ice cream. Okay. What is the validity of an ice cream? Okay. The validity of an ice cream is just 15 minutes. After 15 minutes, what happens? Ice cream will start melting. Okay. You are buying an ice cream. If you are having the ice cream for 15 minutes or 20 minutes, what happens? The ice cream will melt. Okay. And after 15 minutes, what happens? The ice cream will become nothing. The ice cream will become nothing. There is nothing to heat. Similarly, options is also like an ice cream. Options is also like an ice cream. Options is having a validity of 1 week for index options. What is index option? Nifty options. Okay. Nifty options and bank nifty options is called as index options. Nifty option and bank nifty options is called as index options. And it is having a validity of 1 week only. Every Thursday there is an expiry. Every Thursday. And for stock options, TCS options, Reliance options, there is a validity of 1 month. After 1 month, after 1 week, what happens? This options will become zero. Similar to options is like an ice cream. After 15 minutes, ice cream is nothing. Similarly, after 1 week or 1 month, options will become nothing. Option will become zero. Okay. This is an important thing for options. Okay. And there are many terminologies used in option. Okay. You have to just understand the basic. Call option means bullish and put option means bearish. There are many terminologies used in options like strike price. Okay. Like strike price. Okay. You know what is premium. I told, right? If you are buying a call option, if you are buying a put option, you have to pay a premium like health insurance. Okay. And that is called as premium. And there is something called expiry day. What is expiry day? This last Thursday, I told, right? Last Thursday, 1 week for index options and 1 month for stock options. Okay. That is called as expiry day. And spot price. What is spot price? Spot price is called as equity cash price. Equity cash price is called as spot price. And there is something called open interest. What is open interest? Total number of option contracts outstanding. Okay. Open interest means nothing but total number of outstanding contract. Okay. Some people are buying call option. They are not yet closed the position. They are not yet sold the call option. So it is called as open interest. Some people are selling call option. Okay, they are not yet bought, they have not yet closed the position. So it is called as open interest. Clear? These are the basic terminologies used in options. Okay, in open interest there is something very important. Open interest is a very important concept. Okay, I will tell you a basic thing about open interest. See, this is option chain. This is where you have to see the open interest. Okay, you will go to nseindia.com website. Under live market you can see option chain. Okay, under live market, the second column option chain, click on equity derivatives. Okay, and this is nifty. This is option chain for nifty. This entire data is called as option chain. See here, this entire data is called as option chain. Okay, and in this option chain, this side is called as call option. See, this side is called as call option and this side is called as put option. Okay, and these yellow color shades are called as in the money, ITM. They call it as ITM. Similarly, these white color shades are called as OTM, out of the money. These are in the money for call option and these are OTM for call option. And similarly, these yellow color shades are called as ITM for put option. And these white color shades are called as OTM for put option. OTM for put option. Clear? So this is a basic thing. Okay, you are going to see an option chain. You have to know what is ITM and what is OTM. Okay, and in this option chain data, 90%, see, this is the open interest column. This is the open interest column. Okay, so whichever number you are seeing here is called as open interest. For example, in 11,950 strike price, these are called as strike prices. In 11,950 strike price, there are 54,000 open interest. 54,000 outstanding open interest are there. Okay, so what does it mean? Almost in ITM, 90% of the open interest is contributed by buyers. In ITM, 90% of the open interest is contributed by option buyers. Similarly, in OTM, 90% of the open interest is contributed by option sellers. Okay, similarly for OTM of put option, 90% of the open interest is contributed by option sellers and 90% of the open interest is contributed by option buyers. This is a very important thing which you have to know. Okay, see, if you are a very beginner for futures and options, okay, it will be confusing for you in the beginning. Don't worry, in the long run you will easily understand futures and options. You have to practice futures and options repeatedly. Okay, immediately you cannot understand futures and options. It will be bit confusing in the beginning. After 1 month or 2 months, it will be easy for you to understand. So you just observe and you can just take notes. So 90% of the open interest in ITM are contributed by option buyers and 90% of the open interest in OTM are contributed by option sellers. Okay, how we are telling option sellers are in OTM and option buyers are there in ITM? How we are telling? Because see, option price will become zero in OTM. See the option price, all the option price in OTM will become zero. Okay, so who needs the option price to become zero? Only option seller needs the price to become zero. Similarly, see here, all the option prices become zero. Only option seller needs the price to become zero. Only an option seller needs the price to become zero. Clear? So only we are telling in OTM option sellers are dominating. In OTM option sellers are dominating. See, in ITM the strike prices will not become zero. In ITM the strike prices will not become zero. Okay, so only we are telling in ITM option buyers are dominating. In ITM option buyers are dominating. Clear? So if you are going to buy options, if you are going to buy call option, you have to buy call option from ITM only. If you are going to buy call option, what you have to do? You have to select these yellow color strike prices only. If you are going to buy put option, you have to select these yellow color strike prices only. Clear? And among these yellow color strike prices, ignore the last one. Ignore the last one and select the last second strike price or last third strike price or last fourth strike price. So any one of these three you can select for option buying. For option buying, you can select any one of these three. Similarly, in put option, ignore the last strike price. This last yellow color strike price you have to ignore. Okay, this last second you can select, last third you can select, and last fourth you can select. Any one of these three strike prices you can choose for buying put option. This is very important for selecting a strike price. Okay, because what many people will do, they will buy strike prices somewhere here because it is very cheap. The strike price is just 20 rupee, just 30 rupees. So they will be buying a OTM option. You should not buy OTM option because our OTM option is for sellers only. ITM option is only for buyers. We have to buy option only from ITM. So we are always buying deep ITM only, deep ITM contract only we are buying. So this is how you have to select a strike price. Don't forget. If you are buying a strike price from OTM, definitely you will become a loser. Your trade will go in a wrong manner. You will not get profit. So you have to select strike prices from ITM only. Don't forget. So these are the basic terminologies which we use in options. Okay. So understanding futures and options is a very difficult task. Okay. Even though if you not understand anything now, okay, because you are beginner to futures and options, even though if it is little confusing, no problem. In the long run, you will understand. Okay. You can read my material 2-3 times. Okay. You will understand slowly. Okay. And you have to keep on practicing every day. And option buying versus option selling. This is very important. This is a very basic difference. For buying an option, you need only less capital. For buying an option, you need only less capital, and for selling an option, you need more capital. Okay, these are basic differences. And loss is limited to premium, loss is unlimited, and profit is unlimited, and profit is limited. So these are the basic differences in an option. And for an option buyer needs a trending market. An option buyer needs a trending market, whereas an option seller needs a range bound market, because we are buying call option. We are buying a call option only if the market goes up, we will be profitable. Only if the market goes up, we will be profitable. And only if the market goes down, we will be profitable. For example, you are buying a call option. You are buying a call option. Then what do you need? You need a bullish market. So only if the market goes up, you will be profitable. Similarly, you are buying a put option. Okay. And you need a bearish market. Only if the market goes down, you will be profitable. Clear? So we need a trending market. Option buyers need a trending market. Okay. But option sellers are totally opposite. They are totally opposite. Okay. If you are selling call option, what does it mean? You don't want bullish market. So you want the market to be bearish. Or opposite to this. If you are selling put option, you are bullish. So you need the market to go up. So what happens? An option seller needs the market to go down, and an option A put option seller needs the market to go up. So they totally need a range bound market. Okay, so only an auction seller needs a range bound market, sideways market. What is range bound market, sideways market? All the names are same only. Sideways market or range bound market, both are same. So now we will see about the our core concept, scalping. Okay, so far we covered the basics of futures and options. Okay, I hope few people might have understood and few people might have not understood. Okay, because it is not that much easy to understand everything. It is not easy to understand futures and options in a single class. Okay, it needs a lot of experience. So, as I told earlier, the little basics we have covered so far. The little basics we have covered so far, and next we will be seeing about scalping. So, those who are having any doubts in options and futures, kindly ask me right now. If you understand whatever I taught so far, you can type yes if you understand. If you are having any doubts, you can tell me. Is it clear? Am I making the concepts clear, or is it confusing? So if you are having any doubts, you can tell me. See, if you are having any doubts, you can ask me. No problem. Now it is a question and answer session. If you are having any doubt, you can ask me. See, Krishna Sagar and Kiran is asking about strike prices, ITM, OTM, and how to select a strike price. See, for futures, option chain is not necessary. Sasi Kumar, for futures, option chain is not necessary. See, most of the questions are very common. How to select a strike price? Most of the questions are very common. How to select a strike price? I will tell once again. Prashant is asking why I should not select the first strike price. So almost all the questions are related to strike price only. See, Shiva is asking, can I hold options for last hour of expiry day? See, you should not hold an options for a long time. You should not hold, even though it is a call option or even though it is a put option, you should not hold options for a long time. Okay. No, Srinivas Reddy, using the volume of open interest, you cannot predict the direction. See, Bhaskaran, you have to select a deep in the money contract. Okay, once again I will tell about open interest. Okay, listen carefully. See, Alok, you should not carry forward options. I will tell you the reason. You should not carry forward the option to next month. Okay, you can carry forward futures contract, but you should not carry forward options contract. I will tell you the reason. I am going to tell about strike price once again. Okay, see, in strike price selection, this is a very important thing which many people make mistake in selecting a strike price. Okay, let me tell for Bank Nifty. Okay, see, in technically all these yellow color shades are called as ITM in the money, right? And technically all the strike prices which are white color shades, see, from here to here all the strike prices are white color shades. These are called as out of the money. And this particular strike price is called as at the money. Okay, let's ignore at the money. This is at the money. You can just ignore at the money. Just consider ITM and OTM. Just consider ITM and OTM. So this is ITM and OTM of call option, because this is call option side. Okay, and this is put option side, and this is OTM. This is OTM and this is ITM. Here, what I am telling is 90% of the open interest. See this particular column. This last column is called as open interest column. This last column is called as open interest column. 90% of the open interest in OTM is contributed by option sellers. Why I am telling option seller? Because for option seller only, the option price wants to become zero. Okay. I will tell you with another example. For example, I am buying this 30,900 call option. Okay, this Bank Nifty 30,900 call option I am going to buy for 43 rupees. Okay, I am buying for 43 rupees. Now, if this 43 rupees goes to 53 rupees, I am making 10 rupee profit. Now, if the 43 rupees goes to 63 rupees, I am making 20 rupee profit. Clear? Now, if this 43 rupee goes to zero, what happens? I am making 43 rupee loss. Clear? If this 43 rupees goes to zero, I am making 43 rupee loss. Then who is making profit? Option seller is making profit. I am an option buyer. I am buying at 43 rupees. I am making a loss of 43 rupees if it goes to zero. Then in this case, who is making money? The person who sold this call option has made money. Clear? So now see here, all the options here have become zero. All the options here have become zero, and still there are many open interest are there. Still there are many open interest. What is open interest? Just understand what is open interest. Open interest means people, those who have bought, have never sold yet. They did not sell yet. Okay, and people, those who have sold, they did not buy yet. Okay, they are still standing. They are still standing there. Okay, they did not close the position. They did not close the position. This is called as open interest. Okay, so all the strike prices in OTM have become zero, but there are many people standing. Then who are they? Option has become zero, but still many people are standing. Who are they? They are called as option sellers. They are called as option seller. Okay, so if you are buying a strike price, for example, if you are buying a strike price here, then you would have made losses. Let's assume the strike price was 20 rupees. The strike price was 20 rupees. You might have bought 31,000 strike price for 20 rupees. Okay, now it has become zero. Then who made money? Option seller only made money. You made loss. So only an option buyer should buy any strike prices in the yellow color shades. In the yellow color shades, an option buyer can buy any strike prices. In the yellow color shades, an option buyer can buy any strike prices. I am telling you to ignore the last strike price. Why? Because it is at the money, it is at the money, and the effect of premium decay, we call it as premium decay. Option price decreases and becomes zero, it is called as premium decay. If an option price is decreasing slowly and becoming zero, then it is called as premium decay. Okay, so the effect of premium decay will be there in ATM also. In ATM also, there will be a small effect of premium decay. So only to be on safer side, I am asking you to buy the last second strike price or last third strike prices. Okay. So if you are selecting any strike prices here, the effect of premium decay will be very less. Premium decay will be there, but it will be very less. For example, if the premium decay is in OTM, if the premium decay in OTM is 20 rupee, means the premium decay in ITM will be only 5 rupee, 5 rupee or 8 rupee only. So the effect of premium decay is very less in ITM. So whenever you are buying an option, okay, whether it is stocks, whether it is index, anything, if you are buying an option, you should buy in the yellow color shades only. You have to buy in the yellow color shades only. Similarly, for put option also, you have to buy in the yellow color shades, any one. Ignore the last one, ignore the last strike price and buy anything which is inside. Buy anything which is inside. Okay, but to be on safer side, buy the buy any one of these three strike prices. Buy any one of these three strike prices. Sri Chandrasekhar is asking if Bank Nifty moves 100 points, how much option price will go? If Bank Nifty goes 100 points, how much option price will go? See, it is totally dependent on delta and theta value. Okay, there is a concept called option Greeks. There is a concept called option Greeks. Okay, so this price movements is totally dependent on delta, theta, and gamma and vega. Okay, this option pricing. Okay, how this option price is decided, how the option price is changing, these are all totally dependent on option Greeks, delta, theta, gamma and vega. Okay, so we are not going to see in depth about it. We are not going to see in depth about option Greeks. That is not necessary. Okay, and option buying is good or option selling is good. See, option buying is also good, option selling is also good. The thing is, you should play safely. For example, I told if you are an option buyer, you have to select any one of these strike prices. If you are an option buyer, you have to select any one of these strike prices. If you are an option seller, what you have to do? If you are an option seller, you have to select any one of these strike prices. That's all, very simple. It is opposite to option buying. So if you are an option seller, you have to select any one of the OTM contract. Okay. And See, see, Gaurav, 31,000 is having highest call option. Okay, this highest call option is created by FIIs and DIIs. Okay, always you should stand behind of FIIs and DIIs only. Okay, initially as a retail trader, okay, see, we are retail traders. We are retail traders. Our capital will be 1 lakh rupee or 2 lakh rupee or 5 lakh rupee. Okay, and some people capital will be only 50,000. So we are retail traders. Okay, FIIs and DIIs are trading with 4,000 crores, 2,000 crores, 3,000 crores. Okay, so always you should stand behind FIIs and DIIs only. If there is sudden market crash, what happens? FIIs and DIIs are having crores and crores of money. They will easily escape to another strike price, but you cannot escape. FIIs and DIIs will have crores and crores of money. They can take surplus position also. For taking extra position, they are having money. But for taking extra position, you will not have money. Okay. So to be on safer side, always, if you are going to sell an option, if you are going to sell an option, sell behind the highest open interest. Okay, see, here you are seeing highest open interest in 31,000, right? You are seeing highest open interest in 31,000. If you are going to sell an option, sell below these strike prices. Okay, similarly for put option, the highest open interest is here. Okay, sell below those strike prices. To be on safer side, I am telling you. Okay. See, Anish Anthony, I told you the logic of premium price is decided based on option Greeks. Okay, it is decided based on option Greeks. Okay, it is a more mathematical calculation. Okay, options pricing is a very mathematical and boring subject. Option Greeks, maximum pain, put call ratio. Okay, option strategies, many are there. Okay, it is a vast subject. It is a very tedious subject. Okay, it is like studying trigonometry, algebra. Okay, differential calculus and mathematics. Okay, it is like studying for IAS IPS exam. It is very difficult. Okay, and I am not focusing on that. If you are an option buyer, you don't want to focus on option Greeks anything. See, for Prashant is asking how to know the top and bottom of market by reading the open interest. See, according to me, by reading the open interest, you cannot interpret anything. Okay, by reading the open interest, you cannot interpret anything because we are option buyers. Okay, see, option this remember one thing. I will tell you. Okay, many people are misinterpreting. Okay, this open interest and option Greeks put call ratio, maximum pain. Okay, and this India VIX, people will be watching India VIX also. Okay, and this implied volatility. Okay, and there are many concepts, many option strategies are there. Okay, many option strategies are there. Okay, these are not necessary for an option buyer. These are not necessary for an option buyer. Why I am telling it is not necessary for an option buyer? Because for option buyer, we need only momentum. We need breakouts. Okay, we need breakouts. When you will tell, actually, you are going to buy a call option. Okay, you are going to buy call option. When you will buy a call option, only when the market is bullish, you will buy a call option. You are going to buy a put option. When you will buy put option, you will buy put option only when the market is bearish. Okay, now when will you tell market is bullish? When will you tell market is bearish? When will you tell market is bullish? When will you tell market is bearish? You will tell market is bullish when there is a breakout on the upper side. You will tell market is bearish when there is a breakout on the downside. Am I right? You will tell market is bullish when there is a breakout on the upside. Okay, you will tell market is bearish when there is a break on the downside. Okay, so for buying an option, you need momentum. Understand the reality. For buying an option, you need chart. Okay, you need chart, you need momentum. Okay, but for selling an option, you don't need chart. You need to follow FII and DII. In short, if you are an option buyer, okay, if you are an option buyer, follow the chart. Okay, if you are an option seller, you follow FII and DII. Okay, how to follow FII and DII? To follow FII and DII, you have to check the open interest. Okay, because open interest is created by FII and DII only. Open interest is created by FII and DII. So, if you are an option seller, you need to follow FII and DII. Okay, and what are the things which FII and DII do? They see open interest, they see put call ratio, they see implied volatility, they see maximum pain, everything they will be seeing. Okay, so if you are an option seller, don't see the chart. Don't see the chart. You need to see the FII and DII data only. You should be strong in option strategies. Okay, just understand the difference. Okay, we are option buyers. We don't want these data. Okay, in option buying, there is only one disadvantage. Okay, if you are going to buy an option, there is only one disadvantage. Okay, what is the disadvantage? The disadvantage is premium decay. If you are buying an option, premium decay is the only disadvantage. Trading in options require less capital. Yes, even with 100 rupees you can buy options. Even with 500 rupees you can buy options. Even with 1000 rupees you can buy options. Okay. Trading in options requires less capital only, but there is one disadvantage. What is the disadvantage? Premium decay. What is premium decay? Premium will become zero. That is the one disadvantage. So, yeah, premium decay happens because of option Greeks data. Actually, Vihan Patel is asking why premium decay happens. Premium decay happens only in OTM. Premium decay happens in OTM only, and premium decay is less in ITM. Premium decay is less in ITM. Why premium decay happens? Premium decay happens because of time. Premium decay happens because of time. What I told earlier, options is like an ice cream. If you are having an ice cream for a long time, ice cream will become zero. Similarly, if you are having an option for a long time, options will become zero. So premium decay happens if you are holding an option for a long time. To escape from premium decay, you should do scalping only. Okay, to escape from premium decay, you have to do scalping. What is scalping? Buying and selling within 15 to 30 minutes is called as scalping. Not even 30 minutes, within 15 minutes is called as a good scalping. Within 15 minutes, you should do scalping. Okay, you have to buy a call option, you have to sell within 15 minutes. Only then you can escape from premium decay. Okay, because we are option buyers, we need momentum, we need breakout, we need bullish market, we need bearish market. So we are catching the momentum and we are escaping. See, option buying is like pickpocketing. Okay, option buying is like pickpocketing. You have when you are snatching a wallet. Okay, assume you are pickpocketing. Okay, you are pickpocketing, and will you run or will you stand? After doing a pickpocket, you will run, right? Why you are running? Because people will catch you. Similarly, if you are buying an option, you should exit early. Otherwise, premium decay will happen. Otherwise, premium decay will happen. So, if you are an option buyer, you have to do scalping. Okay. If you are doing positional trading in options, okay, for example, see, if you want to do intraday trading, if you want to do intraday options, okay, you have to do scalping. You have to do scalping, and you can ignore all options data. Ignore options data. What is options data? Options data I already told you, right? Open interest, maximum pain, put call ratio, implied volatility, option greeks, everything is called as options data. If you are doing positional options, if you are doing positional options, then definitely you have to see options data is necessary. Options data is compulsory. Okay, because you are holding for 2-3 days, right? What is positional options? You are buying today and you are holding for few days. You are holding for few days. So positional options, you have to see options data. Clear? For intraday, you don't want to see options data. You just want to do scalping. You just need momentum. That's all, nothing else. You need only a momentum. You need a bullish or bearish market. That's all. This is the main importance of an options buying. See, premium decay happens in OTM. Premium decay happens in OTM. Premium decay is less in ITM. Okay, Gaurav, do you understand? The premium decay happens in OTM and premium decay is less in ITM. Okay, and Chandrasekhar asked, trading in options require less capital. Yes. Okay, sometimes options give more profit than futures. Sometimes options give less profit than futures. It is 50-50 chances. Sometimes options will give more profit than futures. Sometimes futures will give more profit for than options. So far we saw about derivatives trading, futures and options basics. Okay. So even though if you are not familiar with futures and options, no problem. You can practice all these concepts in equity cash. You can practice all these concepts in equity cash. So that's not a big issue. Okay. So even though if you are not strong in futures and options, no problem. So now we will see what is scalping. Okay. So as I said earlier, scalping is buying and selling within few minutes. Okay, buying and selling within few minutes is called as scalping. See, this word scalping is very new to Indian traders actually. Okay, because Indian traders are not familiar with scalping. Okay, only forex traders, those who trade in US, those who trade in abroad, they are familiar with scalping. And there are many foreign traders who do scalping within 1 minute. So this scalping itself is a very new term for Indian traders. Okay, so scalping is very simple, buying and selling within few minutes. Okay. There is a difference between scalping and intraday trading. See, in intraday trading, what does it mean? If I am telling I am an intraday trader, it means that I am buying somewhere in the morning. Like for example, I am buying at 9:30, okay, and I will sell at 2 p.m. or 3 p.m. Okay, so this is called as intraday trading. Okay, so I will be holding the position for few hours. Holding for few hours is called as intraday trading. But when it comes to scalping, what is scalping? Scalping means buying and selling within few minutes. Few minutes. For example, if I am buying at 9:20, I will sell within 9:30 or 9:45. So within few minutes, my trade is done. Okay, this is called as scalping. Okay. Now, in scalping, huge wealth creation is not possible. Okay, in scalping, what you can do, you can take only small profits. For example, if you are searching in Google about scalping, or if you are watching any YouTube videos regarding scalping, you can see people will be taking very little profits. Okay, they will be placing huge quantities and they will be taking small profits only. For example, people will be placing 2000 quantities, people will be placing 5000 quantities, and they will be catching only 3 or 5 points. Okay, they will be catching only 3 or 5 points. In that way, they will be making small money. Okay, so huge wealth creation is not possible. Okay, a scalper will exit a trade as soon as he gets a small amount of profit. Okay, and profit or loss is restricted. For example, if you are doing scalping, your result is known within few minutes. Okay, whether you win the trade or whether you lose the trade, the result is known within few minutes itself. Okay, and the success ratio for scalping is very less. Okay, out of 100 traders, only 5 traders are successful scalpers. Only 5 or 10 people can do successful scalping. Why? The reason is speed. Okay, the speed is not enough for many traders. You should be very quick when you are doing a scalping. And the second important thing is you should be very strong in understanding the trend. Okay, if you are entering in a wrong entry, okay, if you are taking a wrong entry, then definitely you will be losing heavily. Okay, so the success ratio is very less in a scalping. Okay, so if you are going to scalping, you should be very strong in understanding the trend and you should be very speed in placing the order. Now I am primarily focusing on bank nifty. I am primarily focusing on bank nifty only. What is the reason? Okay, the reason is in India, bank nifty is the liquid instrument. Most volatile instrument in India is bank nifty. Everybody knows that. Bank nifty moves 300, 400 points easily each and every day. So bank nifty is the very volatile instrument. So I am choosing bank nifty for scalping. Okay, in stocks, what happens? One day the stock will move very nicely. The next day the stock will be slow. The next day the stock will be sideways. But in bank nifty, even in sideways market, at least 200 points swing will be there in bank nifty. Okay, so only I am choosing bank nifty as my primary scalping instrument. Okay, and you can make profit in any direction. You can do many trades in a single day. Okay, when you are doing scalping in one particular script, you don't want to study and research a lot. For example, if you are jumping from one stock to another stock each and every day, you should study that particular stock. You should understand the trend in weekly chart. You should understand the trend in daily chart. You should understand the trend in 1 hour chart. So like this, you have to study a lot when you are choosing different stocks each and every day. But when you are following one script for many days, for many months, you don't want to study and research a lot. Okay. And you can even start with small capital in bank nifty. As I told earlier, even 1,000, 2,000 rupees is enough for buying a option in bank nifty. Okay. And what are the qualities of a successful scalper? Okay, a perfect entry is needed. Perfect entry, perfect risk reward ratio should be needed. Perfect exit should be there, and you should book your profit partially. For example, if you are placing 10 lots, okay, if you are playing with 10 lots, you should book 7 to 8 lots quickly. Okay, you have to book 7 to 8 lots quickly, and the remaining 3 to lots you can trail your profits. Okay, you can trail your profits. This is called as booking profits partially. Okay, and good money management is necessary. Some people, what they do, they will put 1 lakh, 2 lakh in their trading account and they will be taking huge position without knowing money management. Okay, they will be taking huge position. They will be losing 5,000, 10,000, 6,000 in a one single trade itself. Okay, so good money management is also necessary for doing a scalping. Okay, so if you want to do scalping, you should be very strong in technical knowledge. Okay, because scalping is done within 5 to 15 minutes. So you have to enter at the right time. So to understand the right time, you should be strong in technical knowledge. Okay, when you are strong in technical knowledge, you can easily do price action trading. If you are doing scalping, price action trading is necessary. Without price action trading, you cannot do scalping. Okay, if you are doing scalping with indicators, you cannot be consistent in the long run. Okay, because indicators will give fake signals most of the time. The success ratio of using indicators for scalping is 50-50 only. It will not suit all the traders. Okay, one person will be very good at scalping using 4-5 indicators. I have seen many traders who use 3 4 indicators, 5 6 indicators for scalping. They will be successful, but the person who is following him, he will not be successful. The reason is, using indicators, using multiple indicators for scalping will not suit everybody. Okay, but if you learn price action trading, it will definitely suit you. Okay, it will definitely suit you, because price action trading is common for everybody. Okay, so we are going to see about price action trading only. So when I tell the word price action trading, many people think that we are using only candlestick patterns. Okay, the moment I tell price action trading, many people they think we are trading only with candlestick patterns. Okay, many people think we are using only support resistance. Actually, if you search in Google about price action trading, the definition which you get is using only price, using only support resistance, using only candlestick patterns is called as price action trading. Okay, but as a price action trader, we will use indicators also. We will use indicators which is helping us for price action trading. Okay, in price action trading, we should not use indicators, but we are going to use indicators which are going to help or support price action trading. Okay, what are the indicators which is going to support us for price action trading? Means moving averages and pivot points. Okay, these two are the only indicators which is supporting for price action trading. I will tell you how. Okay, there are many indicators, there are 100 plus indicators, but we are using only moving average and pivot points. What is the reason? For example, if you are using RSI, okay, if you are using relative strength index, what is the output you get? The output you get in RSI is overbought or oversold levels. The output of RSI is overbought or oversold levels. Okay, so what happens? This is not related to price. Okay, this is not at all related to price. Okay, because in price action trading we focus mainly on price only, right? In price action trading we focus on price, but RSI is giving us overbought or oversold levels, which is not at all related to price. Now second, if you are using super trend, okay, if you are using super trend, what super trend is doing? Super trend is showing you buy or sell signal. Super trend is showing you buy or sell signal. That is also not related with price. Am I right? This is the signal is called as price? No. Okay, it is giving you buy signal, it is giving you sell signal. It is not at all related with price. Okay, and similarly, even if you take any indicator, MACD is giving you convergence or divergence. MACD is giving you convergence or divergence. So MACD is also not at all related with price. Okay, MACD also not at all related with price. So if you compare all the indicator, it is giving us some other unrelated value. Okay, the values are not at all related with price. Okay, these are not at all related with price. Okay, but when you use moving average, what is moving average? Moving average price is called as moving average. Moving average price is called as moving average. So the output of moving average is average price. The output of moving average is average price, which is directly related to price. For example, I am calculating moving average for 5 days. 1 plus 2 plus 3 plus 4 plus 5. Okay, so I am dividing it by 5. So what I will get? So I will be getting the value as 3. Okay, so this is an average price. So only we are using moving average, which is directly related to price. Moving average price is very important, right? Average price is very important. Okay, because if see, assume one student is scoring 80 marks in all the subject. One student is scoring 80 marks in all the subject. Okay, so what will be the average mark of the student? 80% is the average mark scored by the student. If all of a sudden, if the student is scoring 60%, what does it mean? The student is not studying properly. Okay. Similarly, if the student is scoring 95%, what does it mean? The student is studying properly. The student is performing well. The student is studying well. How we are telling? Because the student average mark is 80% only. If he is scoring 60%, he is not studying well. If he is scoring 95%, he is studying well. So the average mark is very important for a school student. Okay, the average mark is important for a school student. Okay. Similarly, moving average is an important price in stock market. Okay, average price is important for a stock market. If the current market price is above moving average, it is bullish. If the price is below moving average, it is bearish. I will show you in the chart. Don't worry. Now the final indicator which we are going to use is pivot points. Why we are using pivot points? Because pivot points is also called as average price. Pivot points is also called as average price. Why? What is the formula for pivot points? High price, okay, high price plus low price plus closing price divided by 3. So what you are getting? You are getting average price. Am I right? You are getting average price. So pivot point is also giving us average price, which is directly related to price. Okay, so if you compare all the 5 indicators, only moving average and pivot points are giving us average price, which is directly related to price. But MACD is giving us convergence or divergence, super trend is giving us buying or sell signal, and RSI is giving us overbought or oversold level. These levels and these signals are not at all related with price. Clear? So only we are choosing moving average and pivot points as our important indicators. So only we are telling these 2 indicators as price action indicators. Okay. So if somebody is telling you why you are using moving average, you should tell them moving average is an average price. Average price is important in stock market. Okay. Only using the average price you can tell whether the market is bullish or bearish. Am I right? If the market is above average price, then you will tell market is bullish. If the market is below average price, you will tell market is bearish. So if one person is asking you why you are using moving average, why you are using pivot points, you should tell him because moving average and pivot points are price action indicators. Clear? So now we are using moving average and pivot points. Okay. Now, what is the purpose of using moving average? Okay, moving average is a price action indicator, I told. Okay, moving average is a price action indicator. Moving average is a price action indicator. Okay, now in which way it is going to help me? Okay, I am choosing moving average because it is a price action indicator. Now, how it is going to help me in trading? Okay, see, there are 3 trends in market. Okay, there are 3 trends in market. What is the trend? Bullish trend, bearish trend, and sideways market. There are 3 trends in a market. Okay, now moving average will tell us the intraday trend. Okay, we are going to use moving average for intraday. So moving average will tell us the intraday trend. Okay, if you are using in 5 minutes chart, it will tell you the 5 minutes trend. If you are using in 15 minutes chart, it will tell you the 15 minutes trend. If you are using in daily chart, it will tell you the daily trend. So moving average is a trend following indicator. Moving average is a trend following indicator. To understand the trend for intraday, we are using moving average. Clear? So moving average is going to help us by showing us the intraday trend. Okay, so moving average is a price action indicator. It is going to help me for intraday trading by showing us the intraday trend. Okay, without knowing where the bus is going, will you get into the bus? Without knowing where the train is going, will you get into the train? No, right? Without knowing where the bus is going, without knowing where the train is going, you will not get inside. Similarly, without knowing the real trend of the market, you should not enter into a trade. So to understand the trend, okay, to understand where the market is going, we are using moving average. Now I am going to use moving average. Now moving average is going to tell me market is bullish. Now moving average is going to tell me market is bearish. Okay, how far the market will be bullish? Okay, if moving average is telling me, market is bullish or bearish, will the market will go like a rocket? Will the market will go like a rocket? No, right? The market will go only to a certain level. The market will go only to a certain level. Okay, to understand that level, we are using pivot point. Okay, how far the market will be bullish? I am telling, using moving average, I am telling market is bullish. Using moving average, I am telling market is bearish. Now you should ask me, how far the market will be bullish? How far the market will be bearish? So to tell the exact level of bullish and bearish market, I am using pivot points, because pivot points will give me resistance levels, and pivot points will give me support levels also. So I can easily tell how far the market will be bullish and how far the market will be bearish. So far, is it clear for everyone why we are using moving average and pivot points? Just tell me a quick yes. Is it clear why we are using moving average and pivot points? So if anybody is questioning you why you are using moving average, if anybody is asking you why you are using pivot points, you should tell clearly. Okay, you should tell moving average is a trend following indicator. If I am using in 5 minutes, moving average will tell me the trend. Okay, to know the trend, I am using moving average. To know the exact level of bullishness, to know the exact level of bearishness, I am having fever. What is the exact temperature of the fever? Is my temperature is 100? Is my temperature is 96? Is my temperature is 102? I should tell clearly, right? Okay, I am telling I am having fever. Now what is the level of feverishness? The level of feverishness is 103. The level of feverishness is 100. The level of feverishness is 96. Similarly, to understand how the market is bullish, to understand how the market is bearish, I am using pivot points. Clear? Just tell me a quick yes. I need reply from all the 35 participants. See, moving average and pivot points are price action indicator. Okay, like that, if there is any other indicator, we can use it for confirmation. We can use it for confirmation. That's all. Okay. Now we are going to see about moving averages, in depth about moving averages we are going to see. See, now in moving averages, we are going to use only simple moving average. There are many types of moving average, like simple moving average, like exponential moving average, weighted moving average. Okay. And there is also another type called Hull, HULL, Hull moving average. There are many types of moving averages, double exponential, triple exponential. Many types of moving averages are there, but we are going to follow only simple moving average. Why we are following simple moving average? Because simple moving average gives weightage to all the prices equally. Simple moving average gives importance to all the prices equally, but exponential moving average and weighted moving average gives special importance to few certain prices. Exponential moving average and weighted moving average are giving special importance. They are giving special weightage to recent prices alone. They are ignoring past prices and they are giving importance to recent prices alone. Okay, this is partiality. Okay, I don't want any partiality. I need equality. I need equality between all the prices. So only I am using simple moving average. And in this simple moving average, we are going to follow 3 important time frames. Okay, 20 SMA, 50 SMA, and 200 SMA. Okay, for 20 SMA, try to use green color. For 50 SMA, try to use red color. For 200 SMA, try to use black color. Okay, this is for uniformity. Okay, this is a uniform color code. Okay, uniform color code. So if you are posting any chart, I can easily find this is 20, this is 50. Similarly, if I am posting any chart, you can easily understand, okay, green is 20, red is 50. You can easily understand. So this is a uniform color code. Okay, for 20 use green color, for 50 use red color, and for 200 use black or white. Now among these 3 indicators, 20 and 50 are called as twins. 20 and 50 are called as twins because 20 and 50 are having same character. 20 and 50 are having same character, and we are going to use moving average in 5 minutes only. We are going to use moving average in 5 minutes only. Don't forget. You can use in 15 minutes, you can use in 3 minutes, but primarily focus in 5 minutes because we are scalpers. We need 5 minutes only. Now these are the tricks which we are going to see in moving averages. Okay, there are many tricks. As I told earlier, there are 3 trends in market. Okay, there is bullish trend in market, there is bearish trend in market, there is sideways trend in market. Okay, to identify each and every trend, we are going to see few tricks. Okay, we are going to see few tricks. Okay, I will tell you. Okay. And another one important thing, after completing this webinar, okay, tomorrow Sunday it is a holiday, read my material at least 3 times. Read my material at least 2 times or 3 times. Please don't regret reading. Okay, this is very, very important price action methodology, which is used by Ashwani Gujral, which is used by Oliver Velez, which is used by most experienced traders. They will not tell you. Okay, so read my material at least 2-3 times. Okay, now I am going to tell you the character of 20 and 50. Many people will teach you crossover strategy. Many people will tell you golden crossover strategy. Okay, these are very kiddish strategies. Okay, these are school level strategies. Okay, these are primary school strategies. Don't follow them. Okay, there is a true character for 20 and 50. Okay, there is a true character of 20 and 50. If somebody is teaching you crossover strategy, okay, just assume that he is a LKG in technical analysis. Okay, just assume he is a LKG UKG student in technical analysis. Now I will tell you the true character of 20 and 50. Don't blink your eyes. Okay, listen very carefully. This is very, very important. Okay, the first character of 20 and 50 is rising railway track pattern. If you want, you can take notes, but don't forget to listen my class also. Rising railway track pattern, it is the first character of 20 and 50, and this is for identifying a bullish market. This is for identifying a bullish market. Okay, now what happens in a rising railway track pattern? Okay, don't forget we are going to use this in 5 minutes only. Whatever concepts which we are going to see now are only for 5 minutes chart. Okay. And before starting this topic, let me tell you, lunch break will be at 1 p.m. Okay, lunch break will be at 1 p.m. Don't think when I will leave for lunch. Okay, lunch break will be at 1 p.m. only. So listen carefully. In a 20-50 rising railway track pattern, 20 will be going up like this. 20 will be going up like this. And 50 will be following 20. 50 will be following 20 like this. Now see the structure of 20 and 50. Remember, red is 50 and green is 20. Okay, don't forget the color code. Okay, now we are going to see only 20 and 50 character. Okay, now see the structure of 20 and 50. Both are going parallel. Both are going parallel. So only we are calling it as a railway track pattern. How does a railway track looks like? A railway track looks parallel like this, right? Railway track looks parallel like this. Similarly, 20 and 50 are going parallel like this. Now what the candles will do? Now what the candles will do? See, in 5 minutes chart, candles will be taking support at 20 continuously, and the candles will be going up. With the help of 20 SMA, candles will be going up. If 20 is broken, in some cases, the candles will take comfortable support at 50 SMA. The candles will take comfortable support at 50 SMA, and once again the uptrend continues. Okay, so the first point is the candles will take support at 20 SMA, or the candles will take support at 50 SMA. Anywhere the candle will take support. Okay, so the first point is the candles will take support at 20 SMA, or the candles will take support at 50 SMA. The second important point is, each and every time the candles will be making higher high, and the candles will be making new day high. Okay, so each and every time the candles will be making higher high and new day high. For example, at 9:30 the high will be 100 rupees. At 10:30 the high will be 120 rupees. At 11:30 the high will be 140 rupees. Like this, each and every time the candles will be making higher high and new day high. Okay, now this railway track pattern, this is second point. This railway track pattern will be visible for you. This railway track pattern will be visible for you at 10 o'clock. At 10 o'clock. Sometimes before 10 o'clock also it will be visible. Okay, sometimes before 10 o'clock also it will be visible, but the optimum time for railway track pattern visibility is 10 o'clock. Okay, and railway track pattern will be there for the whole day. RTP will be there for whole day. Okay, RTP will be there for the whole day. From morning 10 o'clock to evening 3:30. The whole day RTP will be there. What is RTP? Railway track pattern. Okay, the whole day RTP will be there. Okay, now where you will take position? What you should do? See, this is a pattern for bullish market. You should take position when the day high is broken. Okay, when the day high is broken, you can take position. When the day high is broken, you can take position. Each and every time
when the day high is broken, you can take a long position where you will keep your stop loss. So you have to buy when the day high is broken. Where is your stop loss? Your stop loss will be below 20. Below 20 SMA. What is your target? Your target will be CPR levels. CPR levels R1 or R2 or R1 or 250 percentage. Okay. So this is your important thing. Okay. So once again, I will tell you in a rising railway track pattern, and another one important thing many people will forget. Okay. In a rising railway track pattern, 20 will be above 50. 20 will be above 50 in a rising railway track pattern. Those who are new to moving averages, they will never know this. Okay, so in a rising railway track pattern, it is a bullish identification. It occurs in bullish market. Whenever there is a bullish market, rising RTP will happen. And in a rising RTP, 20 and 50 will be going parallel like a railway track pattern. Okay, the first point is candles will take support at 20 SMA or the candles will take support at 50 SMA. Okay, and each and every time, the second point, the candles will be making higher high and new day high throughout the day, right from morning 10 o'clock to evening 3:30. We will be getting new day high. Okay, each and every time we will be getting new day high. Okay, now when the RTP is visible, sometimes the RTP is visible at 9:15 itself, sometimes the RTP is visible at 10 o'clock. Okay, and the RTP will be there for the whole day till 3:30. RTP will be there. Okay, if you are seeing RTP after 11 o'clock, if you are seeing RTP after 12 o'clock, it is a fake RTP. Okay, how to identify a fake RTP? If it is forming in between the day, if it is forming at 11 o'clock, if it is forming at 12 o'clock, if it is forming at 1 o'clock, it is not at all an RTP. It is a fake RTP. Okay, and the very important thing, when you will buy, when you will go for a long position, you should go for a long position when day high is broken. Okay, when the day high is broken, you will go for a long and your stop loss will be below 20 SMA. Your target will be CPR level. Okay, now I will tell you about this falling RTP. Now I will tell you about falling RTP. This is the concept for rising RTP. Now I will tell you for falling RTP. After that I will show you many examples. Okay. After that I will show you many examples. After completing the examples, you ask the doubts. See, Mohammed Asif, I already told what is the stop loss. Stop loss is below 20 SMA. I have already written in the screen. See the screen properly. Stop loss is 20 SMA, below 20 SMA. Okay. So now we are going to see falling RTP. For bullish market, it is rising RTP. Now for falling market, now for bearish market, it is falling RTP. Everything will be opposite. Everything will be opposite. I will tell you. Just sit comfortably in your chair and just listen carefully. What is RTP? RTP is railway track pattern. Okay. Similarly, we will use this for 5-minute chart only. Again and again, I am telling you should use only in 5-minute chart. Don't ask small doubts like which time frame I should use. Okay, don't ask these doubts. Surely I will cry. Okay, don't ask small doubts like this. You should use only in 5-minute chart. So in a falling RTP, what happens? See, 50 will be going down like this. Okay, 50 will be going down like this, and 20 will be above 50. sorry, 20 will be below 50. This is how a falling RTP looks like. Okay. So in a falling RTP, the very important point, 50 above 20. Now what happens? Now what the candles will do? See the structure of 20 and 50. The 20 and 50 will be going very parallelly like a railway track. Okay. Now what will happen? Candles will take resistance at 20. Candles will take resistance at 20. If the 20 SMA is broken, if the 20 SMA is broken, the candles will take comfortable resistance at 20 SMA. Sorry, 50 SMA. The candles will take comfortable resistance at 50 SMA, and again the downtrend continues. See, again the downtrend continues. Okay, so same way we saw rising RTP, same concept for falling RTP. Now what happens? Now what is the first point? The first point is the candles will take resistance at 20 SMA. Candles will take resistance at 20 SMA, or the candles will take resistance at 50 SMA. So this is the first point. What is the second point? The second point is the candles will be making lower lows. The candles will be making lower lows, and the candles will be making new day low. Lower low and new day low. This is second point. Okay. At 9:30, the low will be 150 rupees. At 10:30, the low will be 130 rupees. At 11:30, the low will be 120 rupees. Like this, each and every time the low will be getting decreased. Now, when you will take a short position, what is short? What is long? Long means buying and selling. What is short? Short means selling and buying. Okay. Now, when you will take a short position, okay, your entry is when the day low is broken. When the day low is broken, you will go for a short entry. And what is your target? Your target is nearest CPR level. Nearest CPR level. What is your stop loss? Your stop loss is above 20 SMA. Your stop loss is above 20 SMA. Same points are applicable here. The falling RTP will be visible from 10 AM or even before. Before 10 AM itself, the RTP will be forming. Okay, and the whole day RTP will be there. Whole day RTP will be there. If RTP is forming in between 12 o'clock, 1 o'clock, 2 o'clock, then it is a fake RTP. Remember one point, you should go for buy only when day high is broken in a rising RTP. You should go for sell only when day low is broken in a falling RTP. Okay. Now I will show you many examples. I will show you examples of charts. See, if day low means current day low. Day low means current day low, not previous day low, current day low. I am mentioning about current day low. See this chart. Okay, see this chart is Jan 20th, 2020. You just look at the 20 SMA and 50 SMA. See the structure of 20 and 50. Okay, see the structure of 20 and 50, the falling railway track pattern is visible for you at 10 o'clock. At 10 o'clock, falling railway track pattern is visible for you. Now what you should do? Now you should mark the day low. Okay, immediately draw a support line at the day low. This is the day low at 10 o'clock. At 10 o'clock, this is the day low. Mark the day low. Okay. Now where you will keep your stop loss? Your stop loss will be above 20 SMA. Okay. If your stop loss is going very high, what you can do? You can keep the candles also as your stop loss. The previous big candle also you can keep as your stop loss. Now what is your target? Your target is the nearest CPR level, which is S2. S2 is your target. After that, what is your target? S3. But before S3, you have to take S2, S3 50% as your target. S2, S3 50% as your target. So your shorting opportunity is activated here. See, slowly the candles are taking resistance at 20. This is the important character of railway track pattern. 20 will resist the candles. 20 will not allow the candles to go up. 20 will not allow the candles to go up. And once again, you are getting a shorting opportunity. See here, at between 12:30, you are getting another opportunity to short. Again, you can short there. Okay. Again, at 1:30, you are getting a shorting opportunity. See, at 1:30, again, day low is getting broken. Okay. So, in a railway track pattern, the whole day it will be forming as a railway track pattern. The entire day, railway track pattern will be active. And each and every time the candles will be breaking the day low. And it will be giving us fresh low. Each and every time the candles will be giving us fresh low. Okay. This is called as falling railway track pattern. We will see another example. See, this is another example on Jan 6. Okay. See, before going to the next example, I will show you action replay in practical chart. I will show you action replay in a practical chart so that you will understand better. So I am going to show you the action replay of February 18. February 18, I am going to show you action replay. Please listen carefully. Okay. We are going to see the action replay for February 18. So this is the first candle. Okay. On 18th February, this is the first candle. Okay. I told you very clearly RTP is visible at 10 o'clock. Okay. See, in some cases like this is what I told. Okay. In some cases like this, in some cases, what happens? RTP will be visible in the first candle itself. See, this is how a root of RTP looks like. See, this is the root of RTP. Okay, the formation of RTP. The formation of RTP will be looking like this. Okay, this is the formation of RTP. Now what you can do, see, slowly RTP is forming. Okay, see, look at the time, 9:40. Slowly RTP is forming. Now what you have to do, you have to mark the day low. Where is the day low? See, the 9:30 candle. The 9:30 candle is the day low. Okay, I am marking the day low. Okay, I am marking the day low. When this day low is broken, when this day low is broken, I will go for a short. I will go for a short. Okay, what will be my target? My target will be CPR. Okay, according to CPR, see, S2 is there. Okay, S2 is there. Okay, since S2 is very near, what I will take? I will take S2, S3 50%. I can even take S2, S3 50%, or even I can take 25% of S2, S3, because even the 25 percentage of S2 S3 will give me more points. See, if I am shorting at this particular point, I will be getting a solid of 100 points at 25 percentage itself. Okay, so whichever is very near, I will exit. Okay, so now I am waiting for a short entry. See, there is no proper candle closing, so I will wait for shorting. Okay, see, look at the RTP. Inch by inch RTP is forming. Inch by inch RTP is forming. Look at the action replay. Okay, inch by inch RTP is forming. Okay, so now we can enter. Okay, now we can enter. Okay, above 20 SMA you cannot keep your stop loss. Above 20 SMA you cannot keep your stop loss, because your stop loss becomes very big. Your stop loss will become very huge. Okay, so what you can do, you can keep your stop loss above the previous candle. You can keep your stop loss somewhere around above this previous candles. Okay, now my short entry is triggered. My short entry is triggered. See, within one candle my target is reached. Within one candle my target is reached. Okay, see, everybody can see the action replay, right? One person is telling he is not able to see the action replay. Everybody can see the action replay, right? Is the action replay clear for you all? You can all see, right? Because one person is confusing me. He is telling chart is not visible, action replay is not visible for him. Okay, so then it is a problem for him. So see, within one candle my target is reached. Okay, within one candle my target is reached. After that, what I can do, I can trail my profits. I can trail my profits, or what I can do, once again I can market day low. See, now if you are let's assume you are watching the market after 10:30 only. Okay, if you are watching the market after 10:30, once again mark the day low. When this day low is broken, again you can go for a short. Okay, when this day low is broken, again you can go for a short. So just look at the action replay. See, short means you can buy put option, or you can short in Bank Nifty futures. Okay, short means you can buy put option, or you can short in Bank Nifty futures. Now see, now I will go for a short. Now I will go for a short. Okay, because day low is broken. Okay, day low is broken, and now there is a fresh day low. Now there is a fresh day low, so I will go for a short. My stop loss will be above 20 SMA. Somewhere around here I will be keeping my stop loss. My stop loss is above 20 SMA. See, the candle is going down very smoothly. Okay, almost the 50 percentage. Now in this case, where you will keep your target, this day low and S3, 50 percentage will be a target. Okay, always you should consider 50 percentage. Don't forget this 50 percentage. Okay, because this 50 percentage target will be easily achieved. After that only the complete target will be done. Okay, so first you should always consider the 50 percentage. Okay, so if I am shorting in this red candle, what will be my target? This 50 percentage will be my target. This 50 percentage will be my target. So approximately how much points I will be keeping as my target means, see, approximately this will be my target. This arrow will be my target. Okay, so I am getting around, I am getting around 80 points in futures. I am getting around 80 points in futures. Okay, see, this is how you have to trade a falling railway track pattern. Okay, each and every time you just mark the day low. When the day low is broken, you take a safe entry. When the day low is broken, you can take a safe entry. See, when the candles are going above 20 SMA, you should be little cautious. Okay, when the candles are going about 20 SMA, you should be little cautious because the bulls are gaining momentum slowly. In a falling RTP, 20 will restrict the candles, 20 will give resistance for the candles. Now if the candles are going about 20 SMA, you should be little cautious because the bulls are gaining some little energy. See, this is how you use a, this is how you trade a falling RTP. Okay, I hope everybody is clear now how to trade a falling RTP. Okay, see, now the day low is not getting broken. Can you see? Can you see? Previously we shorted here, okay, and at the 50 percentage we booked the profit. Now this is the day low. Now this is the day low. This is the day low. Now that day low is not broken. Okay, so you should not short out of enthusiasm. You should not short out of enthusiasm. Okay, you should wait for the day low to be broken. Otherwise, you should not take any entry. See, this is how you have to take a trade. See, as soon as the candles crosses above 50 SMA, falling RTP is over. Because in a RTP, I told candles will take resistance at 20 SMA or 50 SMA. Okay. Now, if the candles are crossing 50 SMA, it means the trend is over. The downtrend is over. Clear? I have shown you the action replay of falling RTP. Okay, this is how you have to trade a falling RTP. So in a RTP, the candles will be taking repeated resistance at 20 SMA. Okay, see here, all the examples which I have added here are pure RTPs. See, the candles will be taking repeated resistance at 20 SMA. See, in this candle also, after seeing the first two red candles, okay, many people will go for a short, okay, but we are waiting for the confirmation of RTP. Okay, see, this is the day low. The day low is broken here. Okay, as soon as the day low is broken, see, the candles are slowly inching downwards. See here, and once again on December 26, on December 26, it is a falling RTP. Okay, at 10 o'clock, RTP is clear, visible for you. Okay, you draw the day low. When the day low is broken, you go for a short. Once again, candles are taking resistance at 20. Day low is broken, go for a short. See, once again, day low is broken and the candles are going down. This is how a falling RTP will be forming. This is how a falling RTP will be forming. This is also same example. Okay, as I told earlier, sometimes falling RTP will be very clear in the morning. Okay, in that case, you can easily go for a short opportunity. Chandrasekhar, yes. day low is today's low. I am telling day low means today's low. See, this concept works everywhere. Stocks, index, crude oil, everywhere you can apply this. Even in crude oil, I will show you the example. See, each and every time the candle is breaking the day low. This is Reliance Industries. Each and every time the candle is breaking the day low. And another important thing, RTP is valid only for that particular day. RTP will not continue for the next day. There are few conditions for RTP. RTP will not continue for the next day. Krishna, you have to always consider candle close for day low. Always you have to consider the candle close only. See my chart arrow. See the arrow which I have mentioned. I always mention the candle which is closing below day low. See the arrow mark. See the arrow mark. Whenever the candle is closing below day low, you can go for a short. See, already I told RTP forms in the morning. RTP forms in the morning. Okay. If it is forming in the afternoon, don't consider. If RTP is forming after 3 p.m., if the RTP is forming after 2 p.m., don't consider. See, this is Bata India chart. See, Bata India, I have added the chart whenever I took the trade. See, RTP is visible for me. Okay. And see, the candles are breaking the day low. You can go for a short. Okay. Book your profit at 50%. Once again, day low is getting broken. Book your profit at S2. Our CPR works beautifully in stocks, index, commodity, everywhere. This is an example for long opportunity. Okay, look at the RTP. This is a rising RTP. In a rising RTP, see the candles are breaking the day high. Where is the day high? First two candles high is called as day high. When the day high is broken, you can go for a long. Once again, day high is broken, you can go for a long. Okay. So each and every time when the day high is broken, you can go for a long. Once again, same example. See RTP on December 13. I have mentioned the date. Why? I have mentioned the date because you can also go back to the same date and you can check by yourself. See, when the day high is broken, you can go for a long. See, this is how you identify a trending market. So, whenever there is a rising RTP, whenever there is a falling RTP, you can easily identify. See, on February 20th, it is an RTP. February 20th, it is an RTP. When you will take your entry? When you will take your entry? See, you have to take entry when the day high is broken. Where is the day high? This is the day high. This is the day high. Okay. When the day high is broken in this green candle, you can go for a long. You can go for a buy. What is your target? What is your target? Your target is nearest CPR. See, R1 is very near. Okay, R1 is very near, so you cannot keep R1 as your target. So what you can do, you can take R1 or to 50%. Very simple. This is how we take a comfortable trade. This is how we take a comfortable trade. Clear? If you have any doubts in RTP, please ask me now. Selected questions. I will reply to selected questions. If I am not replying for your question, then it means your question is very simple. If you have
do you understand rising RTP and falling RTP? This rising RTP and falling RTP you can apply for stocks also. In equity cash also you can practice with 10 shares or 20 shares. See, when the candle is closing above day high, immediately you enter at the closing price. Hemavati, see on February 20, see on February 20, day high is getting broken. This is day high, this is day high. Where it is getting broken? In this green candle. Immediately at the closing of the green candle, immediately you enter. Immediately you enter in this green candle and place your target 50%. Or even if you are happy with your profits, you can exit early also. No problem. See, Prashant is asking how to convert 20 SMA distance as per point for stop loss. See, it's very simple. Okay. When you are entering at 10:45, okay, look at the 20 SMA. Okay, look at the price, approximate price of 20 SMA. See, at 10:45, the closing price 957. I am going to enter. Now, what is the 20 SMA price? I will be keeping my stop loss below that. Okay, so my stop loss will be around 900 or 880 or 890 like that. Approximate stop loss below 20 SMA, because in a RTP candles will not come below 20 SMA. So only we are using 20 SMA as a stop loss. See, Praveen Kumar is asking a good doubt. Okay, if there is a support or if there is a resistance, can we go for a short or long? He is asking. Yes, of course you can go. Of course you can go. No problem. Because 20 and 50 are pushing the price. Okay, 20 and 50 are like a bungee jump. Okay, the candles are jumping from 20 SMA, so it will break the resistance easily. So you can go confidently for a long or short. See, Krishna Sagar, you can see the equity chart and you can go take the trade in options. Okay, and when your target is done, for example, when your 50% target is done in equity, immediately you exit in options. Okay, for that you have to trade only in deep in the money contract. Okay, if you are seeing options chart also, no problem, that is also good only. See, Bhaskaran is asking, sometimes it reaches day high and comes down. Yes, sometimes it breaks the day high and again it comes down. Okay, in RTP, sometimes only your stop loss will be hit. Bhaskaran Subramani, in a RTP, out of 10 trades, maybe 3 trades or 2 trades, your stop loss will be hit. Because sometimes we will get fake RTP also. Sometimes we will get fake RTP where the day high will be broken and immediately it will come down. So those kind of days are possible only. We can, that is out of control. It happens. Arup Chatterjee, 20 SMA changes for every 5 minutes. Should we change our stop loss? Yes. As the candles are making higher highs, for example, see on 20th February, this green candle was breaking the day high. And each and every green candle is going higher and higher. Okay. So what you can do, you can change your stop loss. Okay. Your stop loss is initially at this particular point. After that, what you can do, you can change your stop loss manually. slowly you can bring your stop loss. Okay, that you need some good amount of practice. Okay, so you can change your stop loss, no problem. Chandrasekhar, if the wig is breaking day high or day low, you should not take position. We need a candle close. We need a candle close. See, Nagesh Shetty, if your stop loss is 90 rupees and if your target is 150 rupees, no problem. You change your stop loss. You change your stop loss. You can still stay in the trend. Nagesh Shetty, you can change your stop loss and you can still stay in the trend and book your profit according to the levels. See, Prashant Kumar, this strategy is, everybody listen, this strategy is only for trending market, not for sideways market. Prashant Kumar, I already told, okay, rising RTP is for bullish market and falling RTP is for bearish market. Don't forget. So next we will see about sideways market. Remember, there are three types of market. Bullish market, we will get rising RTP. In a bearish market, we will get a falling RTP. In a sideways market, we will get a flat and zigzag moving average. Okay, I will show you. I will draw and show you for better understanding. Okay, see, I have already mentioned, Prashant Kumar, see the top, bearish market. Okay, for bearish market we will get falling RTP, for bullish market we will get a rising RTP. Arup Chatterjee, Arup Chatterjee, see yesterday's crude oil chart. For crude oil, you should see in US oil only. Okay, don't see MCX and don't tell it is a railway track pattern. Arup Chatterjee, see yesterday's crude oil. Yesterday crude oil is a falling RTP. And you can check in the historical charts also. In crude oil also RTP works. RTP works in currency markets also. Okay, you check in crude oil also, RTP works well. Now we are going to see sideways market. Sideways market is very simple. In a sideways market, 20 and 50 will be flat and zigzag. For example, as I told earlier, this is rising RTP. This is a falling RTP. Okay. In a sideways market, what happens? See, 20 will be going like this, zigzag. And 50 also will be going like this. So 20 and 50 will be flat and zigzag. 20 and 50 will be flat and zigzag in a sideways market. In a sideways market, 20 and 50 will be flat and zigzag. Now the very important thing is, in a zigzag, flat and zigzag market like this, what happens? Candles will be going down. There will be a sudden big red candle. Okay, immediately you will go for a short. Immediately everybody will go for a short. But what happens? The next candle will go up and it will hit all your stop losses. Once again, when the candle is going up, there will be a very big green candle. You will go for a long, I will go for a long, everybody will go for a long. But what happens? The next candle will come down. Okay.
So whenever 20 and 50 are flat and zigzag like this, we will get many trap candles. This is called as a trap candle. This is called as a trap candle. Okay, because people will think, oh my god, market has broken the day high, market is going to go high, everybody will think. But what happens, it is a trap, and you can easily identify the trap when 20 and 50 are zigzag. Okay, you can easily identify a zigzag, you can easily identify a trap market whenever 20 and 50 are zigzag. Okay, and during expiry day, if you are an options trader, okay, if you are an options trader, during expiry day, during Wednesday, during Tuesday, there will be premium decay. There will be premium decay. Okay, that premium decay you can easily identify using 20 and 50. If 20 and 50 are flat and zigzag, easily you can tell it is a premium decay day. Easily you can tell it is a premium decay day. Okay, because whenever there is a premium decay in options, 20 and 50 will be flat and zigzag. Okay, so whenever there is a 20 and 50 are flat and zigzag, you should not trade. Okay, so 20 and 50, it is a no trade zone. Clear? I will show you the example of charts. I will show you the example of charts. See, this is the example. See, 20 and 50. See the structure of 20 and 50. Many people will ask, it is looking like a railway track pattern. See, at 10 o'clock, it is looking like a railway track pattern. Of course, yes, but day high is not broken. The day high is here. Okay, this is how you identify a fake RTP. In a fake RTP, day high will not be broken. Okay, so this is not at all a RTP. This is not at all a RTP. Now see the structure of 20 and 50. See the structure in 20 or 50. The 20 is going in a zigzag manner, and see the 50 is also going in a flat manner. So if it is going like this, then you should strictly avoid trading. Okay, don't take trading in these areas. Okay, you should avoid trading, because what happens, candles will be going down. We will think we should go for a short, but what happens, immediately a big green candle will come. Okay, and as soon as we see these subsequent green candles, what we will think, okay, we will think market will go up to day high, we will think. But what happens, market will come down, the immediate next candles will come down, and it will give us a fear. Okay, and after that, see, after reaching the day high, again they are coming down, but once again they are jumping back, and once again they are coming down. Like this, the candles will be confusing us. The candles will be confusing totally. So you should avoid whenever the 20 and 50 are zigzag. Whenever 20 and 50 are zigzag, you should definitely avoid. You should definitely avoid. Now see this example, Jan 29. See, there is no pattern at all. If you see there is no railway track pattern, you should avoid. See, 20 and 50 are going in a zigzag manner. Okay, 20 and 50 are going in a zigzag manner. 20 and 50 are sleeping. There is no energy for 20 and 50. 20 and 50 are sleeping. Now look at the trap. See, red candles are coming. Everybody will go for a short. Immediately candles are going up. Now after seeing this giant green candle, everybody will go for a long. But see, immediately the candles are coming down. This is how trap occurs. Okay, many people will tell, when I am buying, it is going down. When I am selling, it is going up. Many people will tell, because they will be trading in these kind of days. These kind of sideways days people are trading. That's why many people tell, as soon as I buy, it is going down. As soon as I sell, it is going up. People will be telling. The reason is, this is the reason. Okay. See this example once again. see the structure of 20 and 50. It is a dead sideways market. See, market is going up, coming down, again going up. See the sideways market going up, coming down. Okay, so it is a total confusing market. See the structure of 20 and 50. Your eyes should see the 20 and 50. See, 20 and 50 are flat. Both 20 and 50 are sleeping. So you should not trade. Okay, you should not trade. Now see, repeated crossover. People will teach you crossover strategy. Okay, if you are following crossover strategy, you will lose all your money. Okay, see, it will cross, it will come down. Okay, it will cross, it will come down, and see, it will be confusing totally. See, and again, this is a fake RTP. This is a fake RTP. How you can easily identify a fake RTP? See the structure of 20 and 50. 20 and 50 are looking like a RTP. Okay. See, day low is broken. Where the day low is broken? The day low is broken here. But what happened? Candles are not having the energy to go down. Okay. The moment candles cross the 20 SMA, your stop loss somewhere around here is hit. Okay, your stop loss somewhere around here will be hit. So this is how a fake RTP occurs. Okay, sometimes fake RTP also comes. Okay, and see the market is sideways in this area. So you should avoid trading. So when you use the moving average, you can easily identify whether you should trade or not. The beauty of using moving average is it will tell you the trend and you can decide whether you should trade today or not. The beauty of moving averages is it will tell you whether you can trade today or not. So you can, so half of your tension is reduced. Half of your fear is reduced because you know the trend. When you use the moving average, you know the trend whether you can trade or not. Okay. Now see here, on these days, immediately you can decide you should not trade. See, it is not at all forming a RTP. The moment you see a crossover at 10 o'clock, you can easily tell it is a sideways market. Okay. At 10 o'clock, there is a crossover. We need RTP only, right? The moment there is a crossover, you can tell it is a sideways market and you can close the system. If you want, you can do option selling. If you want, you can do option selling, but I cannot tell how to do option selling. I don't know option selling. I don't do option selling. If you want to do option selling in sideways market, definitely you can do because trend is known to you. Clear? See, this is how we identify a sideways market and this is how we identify a trending market. So many people, what they do, they will be getting trapped in a sideways market. Okay, they will be getting trapped in a sideways market. See this example, till 10 o'clock, RTP is not forming. Till 10 o'clock, there is no RTP. Okay, now it is looking like forming a RTP. It is a fake RTP. Don't take position. Okay, it is looking like forming a RTP, right? What I told, till at 10 o'clock itself, RTP will be visible for you. When I give you the material, you can compare the charts and see. RTP will be forming exactly at 10 o'clock or before 10 o'clock. After 10 o'clock, if it is forming, it is a fake RTP. Okay. So this is how we identify a sideways market. Okay. So now you know how to identify a bullish market, how to identify a sideways market, and how to identify a bearish market. Okay. Now there is one final character for 20 SMA. There is one final character for 20 SMA. So far what we saw, so far we saw rising railway track pattern, which is for bullish market, and in a bullish market we will be getting higher high and new day high. In a falling RTP we will be getting bearish trend and lower low, new day low we will be getting. And whenever the 20 and 50 are flat and zigzag, we will get a sideways market. Now there is one thing, okay, out of 20 trading days, approximately 5 to 8 days we will get RTP. Approximately 5 to 8 trading days we will get RTP. So the remaining 12 to 15 days the market will be sideways. Clear? The remaining 12 to 15 days the market will be sideways. Now we cannot sit ideal without trading for 12 days, right? We cannot sit simply without trading for 15 days. Am I right? We cannot sit simply without trading for 12 days, for 15 days. So in a sideways market, whenever 20 and 50 are flat and zigzag, in a sideways market you can trade based on 200-day moving average. So whenever the market is sideways, you can trade based on 200-day moving average. Okay. In the beginning, I told we are using 3 moving averages, 20, 50 and 200. 20 and 50 are twins, both are having same character. Now, when we will use 200, we will use 200 only when the market is sideways. So, if there is a rising RTP, you don't want to use 200. If there is a falling RTP, you don't want to use 200. But if there is a flat and zigzag RTP, if there is a flat and zigzag 20 and 50 SMA, definitely you should use 200. Okay, the 200 SMA tricks we will see later. Okay, now there is one last character. This is the last character of 20 SMA. This last character is a unique character for 20 SMA. This last character is a unique character for 20 SMA, and this character will happen at 9:15 itself. Many days, 9:15 itself we can take the trade based on this character. I will tell you what is that character. This is a very, very unique character for 20 SMA. Nobody knows this. Okay, nobody knows this. 20 SMA unique character, which is 20 SMA attract candles. 20 SMA attract candles. How the 20 SMA is attracting the candle? There are 3 cases for 20 SMA attracting candles. The first case is rising 20. The first case is rising 20 SMA. The second case is falling 20 SMA. Okay, and the third case is sideways, zigzag 20 SMA. Zigzag 20. Now what happens, listen carefully, this is a very important and very unique trick. Okay, now what happens in a rising 20 SMA, there will be a gap up. There will be a gap up. Now the candles will be going far away from 20 SMA. The candles will be going far away from 20 SMA. The distance between 20 SMA and candles will be very high. Okay, the distance between candles and the 20 SMA will be very high. Now what happens? Slowly the candles will be attracted towards 20 SMA. Slowly the candles will be attracted towards 20 SMA. This reversal point, okay, when the candles will reverse, I am telling when candles are far away from 20 SMA, 20 will attract candles, I am telling. When the reversal will happen, when the candles will come down, the candles will come down as soon as they reach R1 or previous day high, don't forget. So, whenever there is a gap up, whenever the 20 and candles are far away, you can expect a reversal exactly at R1 or previous day high. And when you see some good size red candle, you can go for a short. This is for short opportunity. What is your target? Your target is 20 SMA. This is a very quick scalping. This is a risky scalping. This is a very quick scalping. So you need a lot of practice. Initially, don't try this. Okay. See, if there is a gap up with the red candle, directly you can go for a short. I will tell you. I will tell you. There will be a gap down. Now we are going to see second scenario. In second scenario, there is a gap down and the candles will be going down. Now the distance between the candles and the 20 SMA are far away. The distance between the candle and the 20 SMA are far away. Now what happens? Slowly the candles will be attracted towards the 20. When the reversal will happen? How the reversal will happen? When the reversal will happen? The reversal will happen exactly at S1 or previous day low. The reversal will happen at exactly at S1 or previous day low. Clear? So whenever the candles are far away, from 20 SMA, you can expect a reversal at S1 and previous day low. Okay, and this trick happens at 9:15. As soon as the first candle or second candle is closing, you can easily identify. So in the morning itself, you can apply this trick. Okay, in the morning itself, you can apply this trick. When there is a zigzag 20 SMA, candles will gap up. Okay, the candles will gap up and it will be giving a red candle. Directly it will be giving a red candle and directly it will be coming down. Okay, and this also happens exactly at R1 previous day high only. Similarly, there will be a gap down. And we will be getting green candles, continuous green candles. Okay, so in this case, what you can do, you can go for a long, and this will happen exactly at S1 and previous day low. Okay, so here we will go for a short. See here we will go for a short. Okay, our target will be 20. Here we will go for a long. Okay, our target will be 20. So this is a very small scalping. This trick is especially for small scalping. You have to be very quick. Our profit will be very small. Okay, so you have to be very quick. I will show you the examples. See here, this happened on Jan 6. What you have to do? At 9:15, when market is opening, you have to observe the first candle and the 20 SMA. You have to observe the first candle and the 20 SMA. And you have to see whether there is distance between 20 and candle. So at 9:15 you should see the candle and the 20 SMA and you should check whether there is distance. Okay. Now when you see a red candle, when you see a very good red candle, okay, you can go for a short. As I told earlier, this is a small scalping. As soon as 20 SMA is touched, immediately you should exit. This trick is only for opening. Okay, you should not do in between the day. This is only at 9:15 you should do. 9:15, 9:20, 9:25. Okay, immediately after seeing the first candle, don't go for a short. Wait for a red candle, after that go for a short. See here also, what you should do, see the first candle, see the 20 SMA, okay, there is a distance between candle and 20 SMA, okay, now see, they are rejecting perfectly at R1. Can you see? The candles are rejecting perfectly at R1. After seeing the second doji candle, After seeing the second red candle, you can go for a short. Place your target at 20 SMA. Place your target at 20 SMA. Very simple. This is how you can do a quick scalping in the morning itself. Now see here, this is a gap down. Okay, see the first candle and the 20 SMA. There is distance between the first candle and the 20 SMA. Okay, now this is S1 and this is previous day low. So the reversal is happening inside the area only. Okay, now see the second big green candle. This second green candle is telling you market is going to go up. Okay, and the second green candle is breaking the first candle high also. The second green candle is breaking the first candle high also. You can go for a long. What is your target? 20 SMA is your target. 20 SMA is your target. This is a very quick scalping. Okay, you should exit very quickly. In RTP, you can trail your profits, but in this trick, definitely you should book early. Definitely you should book some quick profit. You should not wait for a long time. Now see, these are very beautiful days where you can make easy money. See, I told you. See the first candle, see the 20 SMA, see the distance. There is a distance between 20 and candle. The first candle is a very big red candle. Okay, after seeing the first candle itself, you can go for a short. As soon as 20 SMA is reached, you can exit. After that, RTP is forming. After that, you can follow the RTP trick, no problem. See here, see on Jan 17. This is a very important day. This is a very important day because see, the first candle is here and the 20 is here. Okay, there is a very huge difference. The distance is very big. Okay, what I did on Jan 17, after seeing the second green candle, I went for a long. Listen carefully. After seeing the second green candle, I went for a long because the first candle high is also broken. So I went for a long. Okay, my stop loss was below the S2. This is S2. I kept my stop loss below S2. But unfortunately, what happened? My stop loss was hit in this red candle. I did not expect the market will come down. I was expecting the market to go up at least to S1 and previous day low. I was expecting at least the market will go up to S1 and previous day low. But unfortunately, my stop loss was hit by this red candle. But what I did, once again the market recovered. See, once again the market recovered and it started going up. What I did, again I entered in this green candle. Again I entered in this green candle. Okay, and once again, as I expected, I booked my profit here because before 20 SMA, see clearly, before 20 SMA, S1 and previous day low is there. So you have to book your profit at S1 and previous day low only. Don't wait for the candle to touch 20 SMA. As soon as S1 and previous day low is reached, immediately you book your profit. So this is how we take a quick scalping. This is also another beautiful day. See, the first candle itself red, second candle is also red. There is a gap up opening. Immediately go for a short. Immediately go for a short and 20 SMA will be a target. Okay, so these are the true and real character of 20 SMA and 50 SMA. So as I told earlier, we saw all the tricks: rising RTP, falling RTP, sideways, and 20 SMA attract candles. Remember one thing, this 20 SMA attract candles you should apply only at 9:15. Don't ask whether I can use it in the afternoon, whether I can use in the evening. Don't ask. You can use. It is little risky. That's why I am not recommending. Okay. So you can use, but even in the mid of the day, it will attract. If you ask me whether 20 will attract the candle in the afternoon, whether 20 will attract the candle in the evening, whether 20 will attract the candle in the night. Definitely it will attract. Definitely it will attract. But for trading that, you need more experience. So initially focus in the opening trade. Okay, practice slowly. After that, you itself will gain confidence. After that, you can trade as you wish. After that, no restrictions for you. You can trade as per your wish. So now we have completed all the 20 and 50 SMA tricks. After lunch, we will see 200 SMA tricks and CPR trick. Now we are going to see about the 200-day moving average. 200-day moving average is also equally important, and it is very simple and easy only. This 200-day moving average, always we will represent 200-day moving average with black color. So if 200 is rising, 200 is rising means market is uptrend only. Similarly, if 200 is falling means market is downtrend only. So if 200 is rising, market is uptrend. If 200 is falling, market is downtrend. We will use 200 only when it is flat. We will use 200 only when it is flat. When 200 is flat, many unusual things happen, because if 200 is rising, market will go up. So no problem for us. Similarly, if 200 is falling, market is downtrend, no problem for us. But when 200 is flat, what happens? Anything may happen. The market will be very volatile. Market might be trending upside or market might be trending downside. Market will be very, very volatile when 200 is flat. Okay. And concepts like short covering, people will tell, right? Short covering is going on, long unwinding is going on. Like this, people will be using some technical terms. Okay. Buyers have emerged into the market. Sellers have emerged into the market. These kind of unseen things, these kind of hidden things can be easily seen using 200-day moving average. See, if the market is sideways, 20 and 50 will be zigzag. I told, if we are in trap, we can easily identify using 20 and 50. When we are in trap, 20 and 50 will be sideways, 20 and 50 will be zigzag. So easily we can tell we are under trap. Similarly, 200-day moving average, whenever it is flat, we can easily tell buyers are emerging and sellers are emerging. Okay, we are going to discuss about that. So the first thing, okay, the first character of 200 is, 200 SMA hate candles. 200 SMA hate candles. 200 SMA doesn't like the candles when 20 and 50 are flat and zigzag. This is what I told. When 20 and 50 are flat and zigzag, most of the times market will be sideways only, because every day we cannot expect railway track pattern. So some days we can get railway track pattern, the remaining days market will be sideways only. For that, we cannot leave without trading. For whenever the market is sideways, we cannot sit ideal, right? Without trading, we cannot sit simply. So whenever the market is flat and zigzag, whenever the market is sideways, we can trade using 200-day moving average, I told. So whenever 20 and 50 are flat and zigzag, 200 SMA hate the candles. So what happens? 200 will be flat like this. Okay. Now there are two possibilities. What are the possibilities? 20 will be upside or 20 will be downside. These are the two possibilities. Similarly, 50 will be upside or 50 will be downside. So this is case 1 and this is case 2. So there are two possibilities. Okay. The first possibility is 20 and 50 will be above 200. The second possibility is 20 and 50 are below 200. So what will happen? Candles will be coming down. In first case, candles will be coming down. Okay. They will break 20 and 50. The candles will break 20 and 50 and they will take support at 200. They will take support at 200. Now what happens? 200 doesn't like the candles. Okay. 200 doesn't like the candles. Now what happens? Immediately the candles will start reversing and they will reach the same place from where it came from. It will reach the same place from where it came from. This is a very important trick. Okay, so 200 hate the candles when 20 and 50 are flat and zigzag. Okay, and similarly 200 will throw the candles when the candles are taking support. When the candles are taking support, 200 will throw away the candle. This is first case. Very simple. Now in second case, what happens? Candles will be going up towards 200. Candles will break 20, 50 and candles will be taking resistance at 200. Candles will be taking resistance at 200. Now what happens? 200 doesn't like the candles, right? 200 doesn't like the candles. So the candles will be thrown away to the same level from where it went up. To the same level from where it went up. So the important point here is candles are thrown away when they take resistance. Okay, this is very, very important. Okay, so why this happens? Why this is happening means 200-day moving average is a long moving average. It is the biggest moving average. Okay. If the candles are breaking the 200, it means the trend is going to change. It means trend is going to change. See, if candles are breaking the 200 downside, what happens? The market will be very, very bearish. If the candles are breaking the 200 upside, then the market will be very, very bullish. Okay. If 200 is broken by the candles, it signifies trend reversal. If 200 is broken by the candles, it signifies trend reversal. So, trend reversal will not happen very easily. Okay, trend reversal is not a piece of cake. Okay, trend reversal is hard like a rock. Okay, so 200 will not allow the candle to change the trend very easily. So only whenever the candle is trying to break 200, 200 will throw away the candle. Okay, 200 is a giant. Okay, 200 is a giant, but the candles are baby. Candles are like baby and 200 is like a giant. So a baby cannot break the giant very easily. Okay, giant is more powerful than the baby. That is the reason why 200 is throwing the candles. 200 is hating the candles. I will show you the example. Before showing the example, there are only two characters for 200. Okay, first character we saw. That is 200 hate candles. What is the second character? Okay, now there is one question. Okay, I told candles will be thrown away when they take support. So whenever the candles are taking support, they will take a U-turn. Similarly, candles are thrown away whenever they are taking resistance. So candles will take a U-turn if they are taking resistance. Okay, now if suppose candles are breaking the 200, what will happen? I told candles cannot break 200 easily. I told, if suppose candles are breaking the 200, what will happen? That is the second character. Okay, that is the second character. Now here one thing I want to add. See, whenever 20 and 50 are flat and zigzag, and if the candles are trying to break, okay, and if the candles are trying to break the 200, let me show you. Always I represent 200 in black color. Okay, so whenever 20 and 50 are flat and zigzag, and if the candles are breaking 200, okay, and if the candles are breaking 200, don't trust the candle. If the candle are breaking the 200, don't go for short. It is a trap. Okay, immediately the candles will go up. Suddenly a big green candle will come and it will go up. So don't short if 200 is broken when 20 and 50 are flat. Clear? Similarly, don't go for long if the candles are breaking 200 when 20 and 50 are flat. When 20 and 50 are flat, don't go for long if 200 is broken. A sudden red candle will come. Okay, so these are trap candles. Okay, these are trapped. So don't take long position, don't take short position. Our motive is to wait for reversal only. Our motive is to wait for reversal only. An important thing we should use in 5 minutes chart only. Clear? So this is the one additional point I want to tell you everybody. Okay. Now we are going to see the second character. What is the second character? The second character is candles are breaking the 200. Okay. The first character which I told is 200 SMA hate candles. The second character is 200 SMA love the candles. Okay. First character is 200 SMA hate the candles. 200 SMA hate the candles when 20 and 50 are zigzag, flat and zigzag. Now 200 SMA love the candles when means when 20 and 50 are forming rising or falling RTP. So whenever 20 and 50 are forming RTP, 200 SMA love the candles. How it is loving the candles, I will tell you. This is 200. This is 200. Okay, this is case 1. This is case 2. So in case 1, what happens? Candles will break the 200 easily. In previous character, I told candles cannot break 200 because 200 is a giant. I told, right? But in this scenario, candles will break the 200 very, very easily because there is a RTP. So the candles are breaking the 200 easily because of the help of 20 and 50, because of the help of RTP. Okay, see, candle alone is unable to break the 200. Now when 20 and 50 are breaking the 200, candle also easily breaking the 200. Okay, it's like see, one person cannot beat a snake. Okay, one person is unable to kill a snake. Okay, now what is happening? 10 people are killing one snake. 10 people are killing one snake. Now what happens? Now even a baby will come and beat the snake. When the snake is dead, even a baby will come and kill the snake. Even the baby will come and stamp the snake. Similarly, candles alone unable to break 200. When 20 and 50 is also breaking the 200, candles are also easily breaking the 200. Okay, so whenever candle is breaking 200, you should check whether there is a RTP. You should check whether there is a RTP. If there is no RTP and if the candles are breaking 200, then it is a trap. Similarly, candles will be breaking the 200 very easily. Candles will be breaking the 200 very easily. The reason is RTP, falling RTP. Okay, because of the help of falling RTP, the candles are breaking the 200 very easily. With the help of RTP, candles are also breaking the 200 very easily. So whenever candles 20 and 50, so whenever candles 20 and 50 are breaking the 200, okay, it signifies trend reversal. It signifies trend reversal. Don't forget. It signifies trend reversal. Okay. When the candle 20 and 50 are crossing 200 from bottom to top, it is called as short covering. It is called as short covering. Short covering means nothing. Very simple. Buyers are emerged. Buyers dominating. That's all. Very simple. That is what they use technical word short covering. Similarly, when candles 20 and 50 are breaking from top to bottom, it is called as long unwinding. It is called as long unwinding. What is long unwinding? Very simple. Sellers are dominating. That's all. So whatever thing is happening behind us, whatever thing is happening in the market, it is visible to us, but we are not seeing it. Okay, we are not seeing it. That is the important thing. Okay, that is what whatever happens in the market. Okay, technicals will tell you, but you should know the knowledge. You should have the knowledge to learn that. You should have the knowledge to see it in your eyes. Okay, this is how people tell short covering, sellers dominating. Okay, this is how people tell. I will show you example. These are the only two characters for 200-day moving average, and these characters are very important and they are very powerful also. I will show you some example. See here, this is on Jan 23. On Jan 23, see what happened. The candles are going up continuously. Okay, but see the structure of 20 and 50. The structure of 20 and 50 are flat and zigzag. The structure of 20 and 50 are flat and zigzag. So what we can expect? We can expect a reversal. We can expect a reversal. This is 5 minutes chart of Bank Nifty. This is 5 minutes chart of Bank Nifty. Okay. So what we have to do, as soon as you see a red candle and as soon as you see a follow through red candle, which means two red candle, you can go for a short. You can go for a short. Now what is your target? Your target will be nearest moving average, because 200 is throwing the candles. Okay, now the candle is rushing towards any one of the two moving averages, either 20 or 50. So your target will be first moving average. See the second example. This is Jan 16. See on Jan 16, the candles are taking resistance at 200. See, continuous resistance. Okay, 20 and 50 are here. 20 and 50 are here. Okay, even though 20 and 50 are forming like a railway track pattern, even though 20 and 50 are looking like a railway track pattern, candles are not having the power. Candles are not having the power to break the 200. Okay, as soon as you see a follow through second red candle, here itself you can go for a short. Now where you will keep your stop loss? Your stop loss should be always above 200-day moving average. Your stop loss should be always above 200-day moving average. Okay, in this case, see, 20 your target is reached, 20 your target is reached, and even 50 also reached by the candles. Okay, this is how happens when 200 hit candles. See another example, Jan 7, same scenario. Okay, see, market is going up. Okay, when in this scenario you should not apply 20 SMA attract candles. See, 20 SMA attract candles, 20 SMA attract candles. When the 20 will attract the candles, you have to see the first candle, you have to see the 20 SMA. There is a huge difference. Okay, you should see for a red candle, right? When you see a red candle, okay, when you see a red candle, when the first candle low is broken, then you can go for a short. But here there is no red candles. Don't go for a short. Don't apply 20 SMA attract candles trick here. Okay, here you have to apply 200 SMA head candles. Okay, see here, before touching the 200 itself, it is like a zone. It is like a zone. So as soon as the candles are nearing 200, you are seeing a red candle, you are getting a follow through red candle, go for a short. Your stop loss will be above 200. Okay, and what is your target? Your target will be nearest to moving average, and 50 SMA is also reached. So this is the original character of moving averages. Nobody will tell you, because even nobody knows this concepts. Okay, nobody knows this concept. That's why people are still cheating you by teaching you moving average crossover, golden crossover. See, moving average crossover and golden crossover are applicable only in daily and weekly charts. Daily, weekly, 1 hour charts, like this longer time frame charts only it is applicable. But in 5 minutes, this is the important characters. Okay, these character you can apply in daily chart also. These character you can apply in daily chart also. Okay, but these crossovers doesn't happen in shorter, small time frame. See here, candles are breaking the 200. See this green candle, it is breaking the 200. Now what everyone will do? Everyone will go for a long. Everyone will go for a long. They will think 200 is broken. But only we people know 20 and 50 are zigzag. So 200 will hit the candles. Now what we have to do? We have to wait for a red candle. Okay, we have to wait for a follow through red candle. See, you can short even in the first red candle. Okay, you can even short in the first red candle. Okay, but initially don't want. Initially I want you all to be safe. Initially I want each and every one of you to be safe. So only I am asking you to short in the second red candle. Once you gain experience, once you gain confidence for yourself, after that you can short in the first candle. So you are going to short in the second red candle. Keep your stop loss above 200. Your target will be 20 and 50 because both are together. Your target will be 20 and 50, both are together. So these are small scalping. You should be very fast. See here, same. See, first candle itself touching the 200 and it is coming down. Okay, and it is coming down. And see, moving averages are also, they are ready to come down. They are ready to break the 200. So you can even short in this red candle, okay, or even you can short in this red candle, okay, and you can book a small profit here. You can book a small profit. Remember, whenever 20 and 50 are flat and zigzag, okay, you have to book only small profits. When you use these kind of tricks, the possibility of hitting your stop loss is very less. The possibility of stop loss is very less. See here, same concept. The first candle itself touching the 200, 20 and 50 are flat and zigzag. What does it mean? 200 hate the candles. Okay, in on Jan 20, 200 hate candles as well as 20 SMA attract candles. Two tricks, two in one. Okay, so you can confidently take the trade. Confidently you can take the trade. Same concept. See the first candle. As soon as the candle is touching the 200, it is thrown away. It is thrown away. Okay, you can short. You can short. After that, see formation of RTP. After that, formation of RTP. Narrow CPR also. Same concept, 200 hate candles. See here, candle is sitting at 200 and it is jumping. Okay, candle is coming down, sitting at 200, immediately it is jumping. Okay, so the moment you see a green candle, the moment you see a follow through green candle, you can go for a long. And 20 and 50 are looking like a railway track pattern. 20 and 50 are looking like a railway track pattern. Okay, so candles are going in a nice trend. This is how you apply 200-day moving average tricks. See, this is Reliance Industries. I am showing you many examples. You have to understand very clearly. This is high probable railway track pattern. I told you, right, when 200 is when 20 and 200 SMA low candles, I told, right, this is also called as high probable railway track pattern because 200 is broken. So this is also called as high probable RTP. What is RTP? Railway track pattern. Since RTP is breaking 200, since RTP is breaking 200, it is called as high probable RTP. It is called as high probable RTP. So see here in Reliance Industries, see 20 and 50 are breaking the 200. 20 and 50 are breaking the 200 and candles are thrown away from 200. See, the moment they touch the 200, immediately they are thrown towards the downside because RTP is forming on the downside, right? RTP is forming on the downside. So RTP is forming on the downside. So market is also going down. 200 is throwing the candles. Very simple. How you will trade a high probable RTP? See, when 200 is broken by candles 20 and 50, when 200 is broken by candles 20 and 50, what happens? Yes, these examples are on spot price only. By seeing the spot price only, you have to take the trade in futures or options. Okay, because From spot only futures and options are derived. Based on spot price only futures and options are moving. Don't think futures and options are moving dynamically. Futures and options are moving based on spot price movement only. So you should always apply these tricks in spot chart and you have to take the trade accordingly in futures and options. Now see, 20 and 50 are breaking the 200. See on the previous day, candles are below 200. On previous day, candles are below 200, but on this day, there is a gap up. There is a gap up, and as I told, 20 and 50 are breaking the 200, which means short covering or buyers have emerged. When you will take position as per RTP, you should take position as per RTP. When day high is broken, go for a long. When day high is broken, go for a long. Once again, when day high is broken, go for a long. So, high probable RTP, you should trade based on RTP concept only. See, this is Maruti Suzuki. Maruti Suzuki, see Maruti Suzuki on February 4. This is a very interesting chart because many days Maruti Suzuki was below 200-day moving average. Many days Maruti Suzuki was below 200-day moving average. After 12 p.m., after 1 p.m., market buyers are emerging. After 12 p.m. and 1 p.m., buyers are emerging. And that is confirmed by the 20 and 50 and the candles. See, here the candles are unable to break the 200. Why? Because 20 and 50 are below 200. But here the candles are easily going above 200. Why? Because 2050 broke the 200. So we can expect a bullish market for the next day also because buyers have emerged, right? Buyers have emerged. So the next day also it is a RTP. So you have to take the trade as per RTP. So these are very simple examples, very easy and simple examples. Once again, this is Bank Nifty December 6 chart. I think I don't want to explain further because candles are broken. Candles are breaking the 200, 2050 are breaking the 200. Sellers have emerged. Market is down. See here, sometimes these are very important days. Okay, it's like meeting Amitabh Bachchan. Okay, you will not get opportunity to meet Amitabh Bachchan or Sachin Tendulkar. Okay, like this opportunities will come rarely. Okay, 2 days RTP. See here, 20 and 50 are breaking 200. Okay, and the next day also 20 and 50 are breaking the 200. Okay, sometimes trap will happen. See, one day market will be going up, next day market will be going down. These kind of trap we can easily identify using 20, 50 and 200. How you will take the trade? As per RTP. When day high is broken, go for a long. When day high is broken, go for a long. When day high is broken, go for a long. When day low is broken, go for a short. When day low is broken, go for a short. When day low is broken, go for a short. Very simple. This happened on Jan 2 and Jan 3. Jan 2 and Jan 3. See, this happened on November 22, November 23, 24, Saturday, Sunday, November 25. See, 20, 50 candles are breaking the 200. When day low broken, go for a short. When day low broken, go for a short. See, after this, market went up. If you have taken trade here, you are profitable. If you are taking trade here, you are loss. Now see on November 25, 20, 50 and candles are breaking the 200. Day high broken, go for a long. Day high broken, go for a long. So two good opportunities you got for taking the trade. So we completed 200-day moving average tricks. There are, you all know about pivot points. Pivot points means very simple. Pivot points means median line. The meaning for pivot points is a median line. Okay, a median line. Okay, above that, it's like a India-Pakistan border. Okay, it's like India-Pakistan border. Kiran, I will clear your doubt after the session. Okay, I will clear your doubt after the session. I will be here until all your doubts are cleared. I am telling to all the participants, after completing the session at around 4 p.m., I will be here till 6 p.m. or 7 p.m. Until clearing all your doubts, I will not go. Don't worry. So if you are having any doubts, you can note down in your note paper, okay? And you can ask me after completing the session. I am ready to clear all your doubts. In my last webinar, I cleared doubts for 100 participants. Okay, till 7 p.m. I cleared doubts for 100 participants. Now you are all only 35 participants. So it is easy for me to clear all your doubts. So don't worry, I will clear all your doubts. I will be here till 7 p.m. also. I will clear all your doubts and then only I will end the meeting. So now we will see about pivot points. If we complete all the concepts now, it will be easy for few people to leave. They might be having some other plans for the weekend. Okay, so first we will complete the session. After that, we can have the doubt session. So pivot points meaning is median line. It's like India-Pakistan border. Okay, above that line, Pakistan, below this line, India. Similarly, pivot point is a median line. Above that line, market is bullish. Below this line, market is bearish. Okay, that is the meaning for pivot point. Okay, in pivot points, there are 6 types. There are 6 types of pivot points. All these 6 types are telling us only the intraday levels. What is intraday level? Intraday level means entry, exit and stop loss. There are 6 types of pivot points. All these 6 types are telling us only where you should enter, where you should exit, where you should keep your stop loss. But there is one unique type of pivot point. See, one thing I will tell to everybody, the original name of CPR is expanded floor pivot points. The original name of CPR is expanded floor pivot points. Okay. I created a trend in India by telling CPR indicator, CPR indicator, CPR indicator. Now everyone in India are telling CPR indicator. Okay, that's how I am telling confidently. I am the first person to tell CPR in India. Many experienced traders were using this pivot point under the name expanded floor pivot points. Nobody used the term CPR indicator. I am the first person in India to use the word CPR indicator. So if you see anybody in YouTube channel telling CPR indicator, then it is because of the name told by me. Okay, because the original name is expanded floor pivot points. Clear? Everybody should tell, if someone is using this indicator, he should tell the original name only, no? Okay, this is not the original name. CPR indicator is not the original name. The original name is expanded floor pivot points. CPR is just a level like resistance and support. Okay, CPR is just a levels like resistance and support. So CPR is a dual role indicator. Why?
because CPR is telling us intraday level as well as intraday trend. If you are using normal pivot points, you will get only levels, right? You just apply pivot points in your chart. You just apply pivot points in your chart, you will get only resistance and support lines. You will not get anything. But when you apply CPR, you are getting resistance and support, you are getting intraday levels as well as intraday trend. What is intraday trend? Narrow CPR, trending market, wide CPR, sideways market, ascending CPR, uptrend market, descending CPR, downtrend market. Like this, CPR is telling you the trend also. So, among all the pivot points, CPR is the only type which shows trend as well as level. So, only CPR is a dual role indicator. That's why we are all following CPR. Okay, see the original name of CPR. The original name of CPR is expanded floor pivot points. You can check in Pivot Boss, Secret of Pivot Boss book. This is the original name. Okay, I gave the name CPR. It is a central pivot range. It is just a term. I created CPR indicator, and everybody copied me. Now, how to use CPR and moving averages together? That is the real challenge. Actually, in all my YouTube videos, I discussed only about CPR. Okay, I discussed only about CPR. I never discussed about moving average because using only CPR, you cannot be successful consistently. Using CPR, you can be successful, but not consistently. So, if you want to be consistently profitable, you need to apply moving average and CPR together. Okay, that's why I didn't reveal moving average tricks in YouTube videos. Okay, and in my YouTube video, I did not tell this particular strategy, and this particular strategy. These three tricks I did not tell in my YouTube videos. Okay, because these three strategies are frequent occurring strategies. Okay, these three are frequent occurring strategies. That's the reason I did not tell in my YouTube videos. Okay, so we will see these tricks. This is a comparison of moving average and CPR. Okay, these three CPR tricks are trending CPR types. Okay, whenever you get narrow CPR, market should be trending. Whenever you get a inside CPR, market should be trending. Whenever you get a trend reversal CPR, market should be trending. But we need RTP also on those days. Only then market will be trending. Okay. In the narrow CPR, many days people will tell, sir, today it is a narrow CPR, but market was not trending. What is the reason? Because in a narrow CPR, we need RTP. Without RTP, narrow CPR will not be a trending day. Okay, I told narrow CPR means trending day, right? Okay, in a narrow CPR day, you should get RTP. In a narrow CPR day, you should get RTP. Okay, see here. If there is a narrow CPR, we need RTP. Narrow CPR plus RTP gives you the trending day. Okay. And wide CPR plus 20, 50 flat and zigzag, you will get a sideways day. Okay. These points are important. Whichever points I have highlighted in yellow color is very important. So you don't miss to read my material. At least you read 3 times. Okay. After that, you practice in charts. See here. See on Jan 17. On Jan 17, there is a narrow CPR. See on Jan 17, it is a narrow CPR, but market is not at all trending. Why market is not trending? Because there is no RTP. There is no RTP. Okay, this is looking like a RTP, but don't tell it is a RTP. It is looking like a RTP, but don't tell it is a RTP because day low is here. Day low is here. Day low is not broken. Only when day low is broken, only when you get lower lows, you will tell it is a RTP. So you should not tell this as an RTP. Clear? So on Jan 17, even though there is a narrow CPR, market was not trending, market was sideways because there is no RTP. See, in a narrow CPR, if there is no RTP, you can expect a trending day on the next day. Read this last 2 point. Okay, we can expect RTP on the next trading day. Don't forget, there will be narrow CPR, there is no RTP, then you can expect RTP as well as trending market on the next day. Now see, on the next day we are getting RTP. Next day it is a narrow CPR once again, and we are getting RTP also. Clear? So whenever there is a narrow CPR, you need RTP. If there is no RTP, the next day it will be a trending day. The next day surely we will get an RTP. This trick also I didn't tell in YouTube. Okay, see, this is a narrow CPR on Jan 14. On Jan 14 it is a narrow CPR, but there is no RTP. See, market was going in a sideways range. There is no RTP. Then we can expect RTP on the next trading day. On the next trading day, whether it is a narrow CPR, whether it is a wide CPR, doesn't matter. It will be a trending day. It will be an RTP. So the next day we got an RTP, market was gap down and market was going down. See, this is how we have to interpret all the concept together. See, this is also a very beautiful example on December 24. See, on December 24, it is a narrow CPR. December 24, it is a narrow CPR, but see, there is no RTP. There is no RTP. Then what does it mean? Then it means that we can get an RTP on the next trading day. We can get RTP on the next trading day. Clear? Very simple. Now this is a weak RTP. It is a weak RTP. See, sometimes whenever there is a narrow CPR, we will get RTP. Sometimes in wide CPR, we will get RTP. Sometimes in wide CPR, we will get RTP. Then it will become a weak RTP. In a wide CPR, if you are getting RTP, it will be a weak RTP and you have to book some quick profits. You have to book some quick profits. See here, candles are breaking the 200. I have given the arrow mark. Candles are breaking the 200 and 20 and 50 are also ready to break the 200. 20 and 50 also ready to break the 200 and the market went down. Okay. So in these kind of cases, you have to book some quick profits. Even though if you are going for a short, you have to come out with small profit. You should not wait for a bigger profit. Now these are common examples. Wide CPR, sideways market. Narrow CPR, trending market. Now ascending CPR and descending CPR. See, on ascending CPR and descending CPR, we may get RTP also, we may not get RTP also. So ascending and descending CPR are just for trend identification. Okay, everybody knows about ascending and descending CPR, right? In ascending CPR, CPR will be going up continuously. CPR will be going up continuously. See, each and every day the CPR is going up. Each and every day the CPR is going up. So the market is also going up. See, each and every day the market is going up. Okay, from this particular point, from 28,200, market went up to 29,600. So 1,400 points market went up. So the overall trend is uptrend.
the overall trend is uptrend. So your view should be on long side only. Your view should be on long side only. Similarly, in a descending CPR, each and every day market will be coming down. This is just for understanding the overall trend. I already told you CPR is a dual role indicator. CPR is a dual role indicator. It not only shows the intraday levels, it shows the intraday trend also. See, each and every day market is going down. Okay, the trend gets over when previous day high and R1 is broken. When previous day high and R1 is broken, then we can expect trend reversal. Then we can expect trend reversal. See, this is also same example. Descending CPR, market is going down. Descending CPR, market is going down. Okay. See, whenever there is an overlapping CPR like this, see, whenever the CPR are together, okay, market may go any of the side. Okay. See, in a descending CPR, you can tell market will go down. In ascending CPR, you can tell market will go up. But whenever the CPR are closer to each other, market may go anywhere. So we have to be cautious while taking a trade. Now, virgin CPR. These are tricks which I have already discussed in my YouTube video. This virgin CPR also, people are having several doubts. Okay. See, virgin CPR have a better accuracy for the next trading day only. Okay. For the next trading day only, virgin CPR will be powerful. Okay. In virgin CPR, there are two categories. There are two cases. Okay. See, this is current day CPR. This black CPR is current day CPR. This orange CPR is virgin CPR. And this black CPR is current day CPR. So there are two cases. Case one is if the current day CPR is above virgin CPR. Case one is if current day CPR is above virgin CPR and if market is opening near current day CPR, what happens? Market will come down to virgin CPR and then it will reverse. Market will come down to virgin CPR and then it will reverse. To be simple, virgin CPR is like a 200-day moving average. Candles will reverse from virgin CPR. Even 200 hate candles we saw, right? 200 SMA hate candles. Similarly, virgin CPR hate candles. If market is opening near virgin CPR, directly it will go up. Okay, so virgin CPR is similar to 200-day moving average. Okay, in case 2, what happens? Market will open near current day CPR. Okay, candles will go up to virgin CPR. After that, virgin CPR will throw away the candle, similar to 200. Similarly, candles will open near virgin CPR, and now the candles will be thrown directly to the current day CPR. Clear? So this is virgin CPR. Please let me have a cup of water. So this is virgin CPR. I hope virgin CPR is very clear for everybody. Clear? Virgin CPR is already available in my YouTube video also. So you can see that we don't want to spend more time in virgin CPR. We will directly go to the example. Now see this example. See, on Jan 29, it is a virgin CPR. Jan 29, it is a virgin CPR. What is virgin CPR? If candles are not touching the CPR, then it is a virgin CPR. See, the moment on Jan 30, the moment candles touching the virgin CPR, it drastically came down. Continuously, it came down. Continuously, it started to fall. So, this is the power of virgin CPR. Okay. And see on this particular day. This is on October 3 and 4, 2019. On this particular day, see, candles are not touching the CPR, so it is called as virgin CPR. Now see, The moment candles are reaching the virgin CPR area, it fall down. So it's very simple and easy to trade a virgin CPR. See, in a virgin CPR, if the virgin CPR is breaking and going up, don't take a long position. For example, in this for example, see this chart. This is a virgin CPR. Now market is breaking the virgin CPR and it is going up. Don't go for a long. You should wait for a reversal trade only. So you can take a trade when the candles are coming out of virgin CPR zone. Okay, and you can book your profit somewhere around R1 or previous day high. Somewhere you can book your profit. Clear? This is another example of virgin CPR. Okay, here also the candles are breaking the virgin CPR. Don't go for a short. See, the candles are breaking virgin CPR. Don't go for a short. You should go for a reversal trade. Now, after seeing this green candle, you can go for a long. Clear? So, to be short in a virgin CPR, we can expect reversal. Now in my YouTube video, I have told many open tricks. Okay, open above R1, below S1, open in between. There are 3 tricks which I told in open. Open above R1 and below S1. Okay, open between R1 CPR and S1 CPR and open inside CPR. Okay, and each of the tricks there are direct and reversal. Okay, there is direct and reversal, direct and reversal, direct and reversal. But what I will tell is, I personally follow only this one trick. Many people used to ask me every day, today what CPR is this? Okay, whether it is open inside CPR, whether it is open in between CPR and R1, whether it is open in between CPR and S1. So people are confused about the open trick. Okay, I will suggest all my students to use only this single trick. Okay, open above R1 and below S1. This single trick is enough for guessing the open. Okay, this is very simple, right? I will tell you. Okay, see here, this is a direct trick. Market many times, I will show you many examples. Candles will open below S1 and previous day low. Okay, so directly market will go down, and in direct trick we will get RTP. In a direct trick we will get RTP. See here, this is also direct trick. This is reversal trick. This direct trick happens most of the time in railway track pattern. I will show you some examples of direct trick. See, this is a direct trick and we will get RTP. This is a direct trick because see, open below S1 and previous day low. Open below S1 and previous day low. So this is a direct trick. S1 is here, previous day low is here. It is opening below S1 and previous day low. We are getting RTP. Okay, and market fall down. See, every time market is coming down. So in a open trick, direct trick, we will get RTP most of the time. See here also. Here also, see. candles are opening below S1 and previous day low, RTP is forming, high probable RTP. See, high probable RTP is forming and it is continuously falling down. So in an open trick, most of the time we will get RTP. See, in an open trick, most of the time we will get RTP. See this area. Candles are opening below S1 and previous day low. RTP is forming and continuously the market went down. So whenever there is a RTP, whenever there is an open trick, there will be an RTP. And reversal trick, you know, at R1 and previous day low, we will get red candles. Exactly at R1 and previous day low, we will get red candles, which means candles are going down. Candles are going down. See, this is also a reversal trick. See, candles are opening below S1 and previous day low. See, exactly it reverses from previous day low. Okay, after that the candle started to move towards CPR. Slowly the candles move towards the CPR. So these common tricks you know very well and you might have seen in my YouTube videos also. Okay, narrow and wide CPR, ascending and descending CPR, virgin CPR and open tricks. Now we are going to see some new CPR tricks which is not discussed in my YouTube channel. Okay, the first CPR trick is inside CPR. What is inside CPR? See, if current day CPR is inside previous day CPR. Okay, see here, day 2 CPR is totally inside. Day 2 CPR is totally inside day 1 CPR. This is called as inside CPR. It is totally inside the range of day 1. Day 2 CPR is totally inside the range of day 1. So this is called as inside CPR. Whenever there is a inside CPR, we can expect a trending day. See the second point, we can expect a trending day. And see the third point, if there is a trending day. See, one thing you should remember, if there is a trending CPR, if there is a trending CPR, definitely we should get RTP. So inside CPR comes under trending CPR category. So definitely we should get RTP. If day 2 there is no RTP, listen carefully, see the last point. If day 2 is not trending, okay, actually inside CPR is a trending CPR. Inside CPR is a trending CPR. If on inside CPR there is no trending day, day 3 will be a trending day. Clear? If day 2 is not a trending day, day 3 will be a trending day. So see the example. See this example. See on December 24. On December 24, see the CPR. I will draw and show you. See, this is December 23 CPR. This 3 blue color line is December 23 CPR. Now see the December 24 CPR. It is totally inside December 23 CPR. December 24 CPR is totally inside December 23 CPR. This is called as inside CPR. So on inside CPR, we need RTP. In an inside CPR, we need RTP. But what happened? See, there is no RTP. And it is a narrow CPR also. It is narrow CPR also. We need RTP. But there is no RTP. So we can expect a trending day on the next day. So see on next day, we got RTP. So the important point is there is inside CPR, there is narrow CPR, there is no RTP. Then what does it mean? It means that we can get RTP on the next day. Very simple. See this example on Jan 8. See on Jan 8, it is a inside CPR. Okay, see, Jan 7 CPR is here and Jan 8 CPR is inside Jan 7 CPR. This is called as inside CPR. But on Jan 8, we did not get any RTP. On Jan 8, we did not get RTP. Then what does it mean? It means that we can expect RTP on the next day. Okay, this is day 1, this is day 2, okay, and this is day 3. So if day 2 we did not get, if we are not getting RTP, we can expect RTP on day 3. So see, on day 3 we got RTP. You trade according to our logic: day high broken long, day high broken long, day high broken long. So this is a very simple and easy to interpret. This is how we have to interpret CPR and moving averages. Now see, this is a general example. Inside CPR, market was trending towards downside. This is December 6. This is December 6, 2019. Okay. Now see the next example. Once again, it is a inside CPR. That's why I have given box. See, on inside CPR, market is trending downside. So inside CPR, everyone is clear, I hope. Now outside CPR is opposite to inside CPR. In a outside CPR, market will be sideways. In a outside CPR, market will be sideways. And this will happen once in 2 months or once in 3 months only. Okay. So outside CPR means market will be sideways. So if market is sideways, what type of moving average we will get? We will get 20-50 flat and zigzag. Like this, you have to interpret CPR and moving averages. Okay. So I have attached the examples. See, this outside CPR is not that much important because it will not form frequently. It will form rarely only. So it is not that much important. See, outside CPR, market is totally in a sideways manner. See, market is totally sideways. And see this example also. Okay, market is totally sideways. Okay, it was a trap. See this red candle, it is a trap. That's what I told. These are trap candles. Okay, market is going up. As soon as this high is reached, again market reversed. Okay, as soon as this low is reached, again market going up. Okay, so like this, market will be trapping us frequently. Market will be trapping us frequently. So you should be cautious whenever there is a outside CPR. Now there is one important trick called trend reversal CPR. Okay, trend reversal CPR is very important. Okay, trend reversal CPR is very important. Now I am going to ask one question to everybody. Let me see who is answering first. We are going to see about trend reversal CPR. Now I am going to ask a question. Okay, let me see who is going to answer first. What type of CPR is this? Muhammad Asif is very speed. Muhammad Asif is the first person to answer. Asif, Praveen, Alok, Sashi Kumar, everybody answer. See, some people are very slow. Yeah, almost all the answers are correct. This is an ascending CPR. Bhaskaran, very late. This is a ascending CPR. In ascending CPR, what will happen? Market is uptrend or downtrend? In ascending CPR, market is uptrend or downtrend? Yes. In a ascending CPR, market is uptrend, right? But what happens? But what happens in a trend reversal CPR? We will get red candles. The candles will refuse to go above CPR. The candles will refuse to go above CPR, and the whole day it will be a bearish market. The candles will not show any interest to go above CPR. The real, actually, it is a ascending CPR. We need bullish market, but what happens in reality means candles will not show any interest. Candles will not even cross CPR. Alok, understand carefully. Candles will not even cross CPR. Candles will be inside the CPR only. Candles will be not at all crossing the CPR, and candles will reject the CPR and it will be coming down. So the whole day it will be a bearish market. This is called as trend reversal CPR. So what does it mean? The trend is changing slowly. The trend is changing slowly. We can expect RTP on these kind of days. Similar thing happens. See, this is a descending CPR. In a descending CPR, what we will expect? In a descending CPR, we will expect bearish market. Okay, but what happens? Candles will not even show interest to go below CPR. They will not even cross the CPR. They will sit in the CPR only. They will take support at CPR. They will take support at CPR and they will be going up continuously. The whole day will be bullish. Okay, and we can expect RTP. This is called as trend reversal CPR. Okay, how to identify a trend reversal CPR? Very simple. I will show you. See this example. This example is very simple to understand. See, this is a descending CPR. This is a descending CPR. Everybody will think market will go down, but see, this is on February 4. February 4, that coronavirus budget, everything happened, right? Everybody was bearish. Oh my God, coronavirus. Everybody is bearish. But see how market went. Market gapped up. Okay, we easily understood. Okay, everybody is bearish, but market is going up. Yes, Ankit is correct. This is also a direct trick. This is also a direct trick. And see, this is a high probable RTP. So how many confirmations we are getting? Trend reversal CPR, direct trick, high probable RTP. Okay. Many people are asking, should I go for long when 50 is breaking the 200? No. See, as soon as RTP is formed, as soon as day high is broken itself, you can go for long. Don't wait for 50 to break. It is very, very late. Okay. As soon as you see RTP, as soon as you see 200 is broken, okay, as soon as you see day high is broken, you can go for a long. Okay, on this particular day, what I did, I went long in this green candle itself because RTP was forming. Okay, it is a gap up and it is a trend reversal CPR. I kept my stop loss here and I went long. Okay, and easily market went up. Very simple and easy to make money. This is how scalping works. When you enter perfectly at the right time, you will make very good amount of money. One day is enough. 1 or 2 days like this is enough to make money for the whole month. See, this is on budget day. Okay, on budget day, many people did not trade. Many people were confused. Okay, see, this is on budget day. See how CPR showed us the trend. You should always thank CPR. Okay, you should respect the CPR. See how CPR told us the trend on even days also. See, this is a ascending CPR. Okay,
everybody thought CPR will be, everybody thought budget will be positive only. So everybody was guessing. Okay, but what happened? See here, candles were rejected by the CPR. Okay, in a trend reversal CPR, what happens? Candles will not go above CPR, I told. Okay, what I thought is on budget day I was trading, that is a Saturday. What I thought is the entire day will be sideways, that is what I was thinking. I thought market will be sideways. That is what I was thinking. Okay. But here what happened? 200 started to hit the candles and it is a falling high probable RTP. I told you should not trade RTP if it is forming in the midday, I told. Okay. But this is an even day. This is an even day. So what I did, the moment I see this very big red candle, I went for a short. My target was just S4. After seeing this big red candle, I thought, okay, market is going to fall because this is a high probable RTP. I went for a short without keeping stop loss and immediately my target was hit. Very simple. Okay. So when you understand the logic, very simple logic only, my dear people. Okay. Nothing is hidden to you. Okay. Nothing is hidden to you. Okay. See, Prashant, this is not a direct trick. Prashant, this is not a direct trick because in a direct trick, we need at least 2-3 red candles. Here, the first candle is only red. Other candles are green only, right? Prashant, other next, second candle, third candle and fourth candle are green. So, this is not a direct trick. Okay. Once again, you read my material in direct trick, you will understand. And these are other days of trend reversal CPR. Trend reversal CPR. See here, it is a ascending CPR. Okay, everybody will think market will go up. Okay, how to identify trend reversal CPR? Chandrasekhar sir, see this is a ascending CPR. Even you answered ascending CPR. Okay, see this is a ascending CPR. Okay, but the candle will reject CPR and it will come down. Okay, ascending CPR means candle should go up, right? But here the candles are not interested to cross the CPR itself. This is called as trend reversal CPR. Yes, correct. Gaurav is correct. High probable RTP. Confirmation of downtrend. You can go for a short. That is a direct trick also. Direct trick also. So you can go for a short. See, even now itself everybody started to answer. This is how you get confidence when you know everything. See, another trend reversal CPR. Okay, descending CPR. Okay, descending CPR, but market is taking support at CPR and it is going up. Okay, and on this day we got RTP also. See the trend reversal CPR. It is a ascending CPR. Everybody will think market will go up, but the candles are not respecting the CPR. The candles are not ready to cross the CPR. They will take resistance at CPR and they will fall down. This is called as trend reversal CPR. Okay. The trend is reversing because fresh sellers or fresh buyers are emerging into the market. That is the reason for trend reversal CPR. Okay, so far we saw two important tricks: inside CPR, outside CPR, and trend reversal CPR. In this, outside CPR is not necessary because it will not happen all the time. Now we are going to see another unique type: Camarilla pivot points plus CPR. Camarilla pivot points plus CPR. Listen this carefully. Okay, this is also a quick scalping trick. Okay, this is a very quick scalping trick. So what we are going to do, we are going to use Camarilla pivot points. I will tell you how to apply Camarilla pivot points in the chart. Don't worry. Camarilla pivot points. Okay, I will tell you the general concept of Camarilla pivot points. I will tell you the general concept of Camarilla pivot points. See, Camarilla pivot points is a type of pivot point which has pivot point, it has R1, R2, R3 and R4. Similarly, Camarilla pivot points is having S1, S2, S3 and S4. So Camarilla pivot points is a type of pivot point. The formula for Camarilla pivot points is totally different. The formula for Camarilla pivot points is totally different. In this Camarilla pivot point, we are going to use only R3 and S3. Listen carefully. Camarilla pivot points is a type of pivot point. It has 4 resistance. It has 4 support value. Okay. In this resistance and support, we are going to use S3 and R3 only. Other resistance and other support are not necessary for us. Okay. So what I am going to do, I am taking that resistance alone separately. I am going to take that support alone separately. Now how to use Camarilla R3 and how to use Camarilla S3? Listen carefully. This Camarilla R3 and S3 are similar to 200-day moving average. Or similar to 200-day moving average. What happens in R3? Listen carefully. What happens in R3? See, candles will be going up. The moment candles touch the R3, we can expect a reversal. So, R3 is a place for going short. R3 is a place. What is R3? Camarilla R3. Camarilla R3 is a place for going short. Similarly, at S3, what happens? Candles will be going down. Candles will take support at S3 and immediately candles will start reversing. So, Camarilla S3 is a place for going long. Okay, very simple, right? This is the general concept of Camarilla pivot points. Here, if you are taking R3 and S3 reversal trade in Camarilla, out of 100 trades, okay, out of 100 trades, 50 trade will be profitable, okay, and 50 trade you will be losing. Okay, if you are using Camarilla R3 and S3, 50 trade you will be profitable, 50 trade you will be losing. Okay, so to increase the profitability, to increase the probability of winning, we are introducing our king. To increase the winning probability, we are introducing our king CPR. How to use CPR and how to increase the winning probability? It's very simple. If Camarilla R3 is coming inside CPR, listen carefully. If Camarilla R3 is coming inside the 3 CPR lines, then the probability of reversal is very, very high. Similarly, if S3 is coming inside CPR, the probability of reversal is very, very high. Now, out of 100 trades, 80 trades you will be profitable, 20 trades only we will be in a trouble. Okay, so the ratio is getting increased. So this is called as high probability reversal. High probable reversal. Okay, it's very simple, right? Everybody understood, right? I will show you how to apply Camarilla pivot points. It is very easy only. I will tell you. Okay, so you just go to indicators. You go to indicators and you type pivot points. Just pivot points. In this, you will get pivot points standard. How to apply Camarilla pivot points? See here, go type pivot points, okay, and type pivot point standard, okay, and click this pivot point standard. After clicking the pivot point standard,
go to this pivot settings. Go to the pivot settings and under inputs you have to change to Camerilla. See, under inputs you have to change to Camerilla, and under style select only S3 and R3. Under style select S3 and R3 and click OK. Okay, you can give some thick color for Camerilla R3 and S3. See, this is Camerilla R3 and S3. Okay, now what I am going to do, I am going to switch on CPR also. So now I have switched on CPR also. Now what I will do, if R3 and S3, any one line should be inside CPR. If R3 and S3 is not inside CPR, what I will do, I will switch off the Camerilla. Listen carefully. If R3 and S3 is not inside CPR, I will switch off. If R3 and S3, any one line is inside CPR, then I will use. See, on 19th February, R3 and S3 is not inside CPR. So I will not use, I will switch off. Now on February 18, R3 is inside CPR. R3 is inside CPR, but candles are not at all coming near the R3. So you don't want to use. You just switch off it, no problem. Okay, it is not necessary for the candle to reverse at R3. Sometimes candles will go down also. Clear? Now see on this particular day, see on 17th February, R3 is inside CPR. R3 is inside CPR. See, before touching the R3 itself, the candle started to fall. Okay, so these are uncertainties. We cannot do anything. So ignore 17th February also. Now see on 14th February. This is very, very important. See on 14th February. On 14th February, I told 200 SMA hate candles, right? I told 200 SMA hate candles. Now see, you are getting another confirmation for going short. What is the another confirmation? See, R3, Camerilla R3 is inside CPR. Camerilla R3 is inside CPR. What is R3? R3 is for short. R3 is for short. When you will short, when a red candle is breaking R3, when a red candle is breaking R3, when the candles are reversing from R3, I will go for a short. Okay. So in this red candle itself, I can go for a short. I can go for a short. Additionally, 200 SMA hate candles is also there. See here, additionally 200 SMA hate candles is also there. Okay, so this is a high probability trade. So several confirmations is there. See, descending CPR, am I right? This is descending CPR, 200 hate candles. This is second confirmation. Okay, and see, Camerilla CPR, Camerilla plus CPR. Camerilla plus CPR, it is a reversal trade. This is third confirmation. Okay, so 3 confirmations you are having. When you have 3 confirmations, you can go for a sure short trade. This is a high probable trade. This is a high probable trade. Clear? I hope everyone understood this Camerilla. We will see some other examples in the material. Okay, see, this is a very quick scalping. Okay, this is a very quick scalping. If you are a very beginner, okay, if you are scared to take position, no problem, you can stay away from the trade. It is not compulsory to take a trade. See here, R3 is inside CPR. On Jan 28, R3 is inside CPR, okay, and this candle is breaking the R3. This candle is breaking the R3. You can go short there itself, but since 20 SMA is below, sometimes 20 SMA will give support for the candles. So what I have given is, when 20 SMA is broken, you can go for a short. See, 20 SMA is broken by this red candle. So you can go short in this red candle because Camarilla R3 reversal trade. So when 20 SMA is broken, you can go for a short. Your target will be previous day low. This black line will be a target. Similarly, see here. Camarilla R3 is breaking, right? Camarilla R3 is breaking by red candle. Okay, but when the previous swing low is broken, you can go for a short. What will be a target? Same, previous day low will be a target. Clear? Because Camarilla R3 plus CPR, it is a reversal trade. See, Camarilla R3 inside CPR, high probability for short setup. Short when the candle is breaking R3. R3 is for short. Yes, whenever Camarilla is there, 20 and 50 will be zigzag. Because 20 and 50 will be zigzag in Camarilla. See this point. In a Camarilla, 20 and 50 will be zigzag only. We will not get RTP in this kind of market. See again, we are getting another scalping opportunity. Okay, see R3 is inside CPR. The moment candle touch the R3, they started to reverse. Now you can go for a short. What is your target? CPR is here, previous day low is here, 50% will be a target. 50% will be a target. Same thing is happening. Okay, same thing is happening here. See, the moment candle touch the R3, this is on December 6. This is on December 6. The moment candle touch the R3, candle started to reverse and candle started to fall. On this day, we got RTP. On this day, we got RTP. Yes, inside CPR, many confirmations are there. Inside CPR, R3 reversal, we got RTP also. Okay, many confirmations are there. So this is another example for long entry. Okay. So we have completed all the CPR tricks. Okay, we have completed all the CPR tricks. So far we saw moving average tricks and CPR tricks. We completed all the moving average tricks as well as CPR tricks. Okay, in CPR tricks we saw additional tricks. CPR, we saw additional tricks like inside CPR, outside CPR, trend reversal CPR and Camarilla CPR. Camarilla R3 S3 plus CPR. So if you understand all the CPR tricks, type yes. Is it clear? Even if it is not clear, don't worry. Read my material. It is very, very simple to understand. I have given like a 2 marks. When you are studying in school, we will have 1 mark question, 2 mark question, right? Similarly, I have given 2 mark notes only. Very simple notes. So even if you not understand, don't worry. Read my material, you will understand. Purushottam, don't worry. Don't worry. When you read, you will get cleared. So now we are going to see about some candlestick psychology. Shriram, once again, you are asking for camera setup. Okay, let me tell after completing the session. And Gaurav is asking about 14th February chart. What is there in 14th February? See, 14th February, it is not a high probable RTP. 14th February, 14th February, it is a fake RTP only. Because in a RTP, day low should be broken. In a RTP, day low should be broken. Here, day low is not at all broken. So this is not an RTP. This is not a high probable RTP also. So I will tell you how to plot tomorrow CPR in next day. Okay, see Chandrasekhar is asking for how to plot tomorrow CPR. See, it is very easy. Okay, if you want to plot tomorrow CPR, if you want to check tomorrow CPR, what you have to do? You just switch off moving averages and okay, and go to CPR settings. Under CPR settings, go to inputs. In CPR under inputs, what you have to do? Switch off all the levels. Switch off all the levels. Just switch on show tomorrow pivots. Just switch on show tomorrow pivots and give OK. Okay. Now what you have to do? You have to hide the candles also, because tomorrow pivots will be showing on current chart only. Tomorrow pivots will show on current chart only. So you have to switch off the candles also. Okay. Now you can see we are getting ascending CPR. We are getting ascending CPR, right? Now what I will do, I will extend this line. I will extend this CPR. I will draw a manual CPR line here. Okay. This is how you can draw. Because tomorrow CPR doesn't display in next day chart. Okay. So this is tomorrow CPR. Now what I will do? Now I will turn on the candles. I will go to CPR. I will switch off tomorrow CPR. I will keep tomorrow pivots. I will keep previous day high low. Okay. And I will give OK. Now see, tomorrow CPR is here. It is we are getting ascending CPR for tomorrow, for Monday. Okay, and see, switch on the moving averages. Okay, now you can easily guess what will happen on Monday. You can easily guess what will happen on Monday. It is very simple. See, now we have drawn the tomorrow CPR line. Okay. Now just look at the moving average. Okay. Just look at the moving average. Look at the structure of moving average. See, 50 is above 20. 50 is above 20, which means bearishness. If 50, remember one thing, if 50 is above 20, it is bearish. If 20 is above 50, it is bullish. Okay, so now we are getting ascending CPR. Okay, this 200 is also rising, but the 20 and 50 are facing downwards. So on Monday we may get a sideways market. We may get a sideways market, or even we may get a high probable RTP. Okay, the formation of high probable RTP is not that much easy, because there is a large distance. Because the distance between 20, 50 and 200 is far away, right? So what happens? 200 will come like this. Okay, 20 has to cross here and 50 has to cross here. So formation of high probable RTP is very less. Okay, otherwise it will happen in the afternoon only. Formation of high probable RTP happens in the afternoon only. So what we can expect on Monday is we can expect a sideways market on Monday. When 200 will be going like this, okay, and 20 and 50 will be going in a zigzag pattern like this. So on Monday we can expect a sideways market, okay, and if there is a gap up or if there is a gap down, then it is out of control, okay. It is out of control. It might be due to news also. News also may impact the market. So this is how we can prepare for the next trading day using tomorrow CPR. See, the probability of bullish market on Monday is very less. The probability of bullish market on Monday is very less because 20 is facing down. 20 is below 50. So the possibility of uptrend is very less. We can expect sideways or downtrend. See, to apply my CPR indicator, go to indicators. To apply my CPR indicator, go to indicators, type pivot, P-I-V-O-T, pivot. Under public library, you will get my name, Gomati Shankar, 1970 likes. Okay, pivot points CPR with monthly, weekly, daily, high, low, Gomati Shankar, 1970 likes. Click that. Vihan Patel, did you find my indicator? And Pawan Kumar is asking whether we can use weekly and monthly CPR. See, weekly and monthly CPR you can use, okay. What I will tell is weekly high low, monthly high low is important. Weekly high low and monthly high low is important. Weekly pivots and monthly pivots you can use, okay. Don't rely on weekly and monthly pivots too much. Just a reference level you can use it. Okay, just for reference you can use it. Okay, like for example, see, I have kept weekly pivots. Okay, exactly if you are using weekly CPR and monthly CPR, TC and BC is not necessary for weekly and monthly CPR. TC and BC is not necessary for weekly and monthly CPR. See, Leonard, we have to use same CPR for crude oil. We have to use same CPR for crude oil also. See, Shiva is asking, should we consider Nifty and Bank Nifty chart together to take a trade? No. Don't take decision based on Nifty and Bank Nifty. If you are trading in Bank Nifty, watch only Bank Nifty chart. If you are watching Nifty, watch only Nifty chart, because many times I have tried, okay, and it will confuse. You will never take a trade. It will confuse you. Okay, because Nifty will be flying, but Bank Nifty will not move. Okay. No, don't watch. Don't watch Nifty and Bank Nifty together. It will confuse you. Don't watch Nifty and Bank Nifty together. Okay, you can try to watch, but it will confuse you, because it was confusing for me. Okay, so it will confuse. So if you ask me which is better for trading, Nifty or Bank Nifty, I will tell Bank Nifty only. If you ask which is best, Nifty or Bank Nifty, I will tell Bank Nifty only. Reason for selecting Bank Nifty, already I told why we are using Bank Nifty scalping. In India, Bank Nifty is the volatile script. Nifty moves only 50 points or 80 points. Bank Nifty moves 200, 300 points. For me, money is ultimate goal. I need volatility. In Bank Nifty, I get many trades in a single day. Bank Nifty moves 200 points easily. Bank Nifty moves 300 points easily. But Nifty moves only 50 points or 80 points. So now we will see let me complete the presentation. After that, we will have other question answers. So some important last 20 slides. Okay, we can complete in 10 minutes. There are important candlestick patterns. Okay, some psychology. Okay. Bhaskar, don't worry, I will tell you how to set up. Bhaskar and Narasimha, don't worry about the settings. I will guide you at the end of session. I am here, don't worry. So, sir, there are some important candlestick psychology, okay, which you should use only in 5 minutes chart. Okay, this one repetitive pattern. This is a repetitive pattern which is my personal observation. Okay, whenever this pattern comes, I used to make 15 to 20,000 very easily because these patterns are tattooed in my brain. These patterns are tattooed in my brain. So whenever these patterns come and whenever CPR and moving averages comes in my favor, I never miss to make good money. So that repetitive pattern I am sharing with you all. So listen carefully. These are money making patterns. Okay, I will show you. See, I will explain this pattern, how it looks like. Okay, the first candle will be very big red. See, remember, listen this pattern very carefully because in February, in the month of February, 2 times it came. Okay, and the 2 times myself and my students, all my students, they made good money. See, the first candle will be very big red. The first candle will be very big red, and the second candle or the subsequent candles will be breaking the first candle low. First candle low will be broken. First candle low will be broken, and you are getting descending CPR, you are getting narrow CPR. These are additional confirmation. Okay. This first big red candle is my pattern. This first big red candle is my pattern. I will show you some examples. See on Jan 6. See December 3 and see Jan 6. Okay. See both the days. See first big red candle. First big red candle is there. Okay. And see first big red candle, and the first candle low is broken by the second candle. Okay, and RTP is clearly visible in the morning itself. Okay, even when the day low is broken, you can go for a short. Okay, but most of the time I will short on the second candle itself. Okay, most of the time I will short in the second candle itself. Now I will show you one thing. See, just look at the Jan 6 chart very clearly. Just see the Jan 6 chart very clearly. Red candle. Okay, there is a gap down. There is a red candle. Okay, there is a RTP. First candle low is broken. Okay, and market was down. Now, see what happened on Jan 15. Can you see any differences between Jan 6 and Jan 15? Just look at the candles. See, gap down, first big red candle, first candle is broken by subsequent candles. Okay, you can short and you are making some good money. See, you got my point, right? This is a very successful pattern. This is my secret pattern. This one pattern will give you many money. Now see Jan 30. Can you find any difference between Jan 15 and Jan 30? Just observe the candle. So these are very repetitive patterns. Okay, first big red candle, high probable RTP, first candle low is broken by subsequent candles, go short, make money. See, target, as I told earlier, Chandrasekhar, target is as per CPR. For example, if when the first candle low is broken by this red candle, okay, you can go for a short where you will keep your target. Your target will be S2, S3, 50%. This 50% is your initial target. Okay, and where you will keep your stop loss. Here you cannot keep your stop loss above 20 SMA because 20 SMA is far away, right? So where you can keep your stop loss, you can keep your stop loss somewhere around the previous candle high, okay, or this red candle high. You can keep your stop loss. Yes, Jan 30 it is a high probable RTP. Jan 30 it is a high probable RTP. So multiple confirmation. And trend reversal CPR also. Can you see trend reversal CPR? Ascending CPR. Okay. People will think market will go up, but candle is rejecting the CPR and coming down. This is a trend reversal CPR. Okay. And candles 20 and 50 are coming down, which means fresh sellers are emerging into the market. Fresh sellers are emerging into the market. Okay, so this pattern is clear, right? First red candle, and the first red candle will be broken by subsequent red candles. Okay, and we will get some RTP. See, same thing happened on February also. I will show you the chart. You should not miss these kind of days. Okay, see, same thing happened on February 18. On February 18 morning itself, I told to my students, it is a high probable, this is a very good pattern, this is a repetitive pattern. I told to all my students. See on February, see initially this weekly, monthly pivots are not necessary. See, in this kind of market, Chandrasekhar, in this kind of market, what you can do, you can take a short position and you can just ride the trend. See, it is a descending CPR. First confirmation is descending CPR. Okay. And second, see falling 200. Falling 200. That is second confirmation. And see, this is a RTP. RTP, first candle is a very big red candle. First candle low is broken by second red candle. Go for a short. Your stop loss will be above S1. Okay. And see, easily you are making profit. S2 is reached. S2, S3, 50% is also reached. It's a very clear cut RTP. And see on this particular day also. See on February 13. February 13, same pattern. Okay. February 13, same pattern. See, first candle is a very big red candle and first candle low is broken by subsequent red candles. You can go for a short. Okay. Actually 208 candles. Actually 208 candles. But here I just applied the candlestick psychology. That's all. I applied candlestick psychology because this is a repetitive pattern. I am watching this pattern several months. So you can go for a short. And 200 is also broken. See, even after 200 is broken, somewhere around here you can go for a short. If you are afraid to short somewhere here, you can take short position after seeing this red candle. Book your profit here. Small scalping. Small and quick scalping. See this also a repetitive pattern. Yes, Leonardo. This pattern applies for long also. See, first candle is a very big green candle. First candle high is broken by a green candle. Okay, you can go for a long. You can go for a long. And see the repetitive pattern on February 10. Again and again repetitive pattern. But I traded only two patterns because other days I was on work, so I did not watch the market. See first candle low is broken by subsequent red candles, short, target, done. Yes, inside CPR, correct. Thank you, Gaurav. See, Gaurav is on fire. He is answering very speedily. Inside CPR on February 10. Inside CPR on February 10, you can expect a trending market. Similarly, market went down. And next day also market went up. See, this is also a repetitive pattern. But market did not went down. Of course, stop loss should hit. At least one day it should hit, right? Otherwise, we will gain head weight. And we will think we are the god of market. So that is an important pattern according to me. Okay, this pattern is very important according to me, and this is also another important pattern. Okay, always remember one important point: market will reverse at R1 or previous day high. So whenever the candles are approaching R1 or previous day high, don't take any fresh position. Okay, because sometimes market will reverse. Similarly, most of the time market will reverse at S1 or previous day low. So whenever the candles are approaching S1 or previous day low, don't go for fresh position. Wait and observe the market, because most of the time reversal will happen. Most of the time reversal will happen at this particular area. Reversal will happen at this particular area. So don't take any enthusiastic trade. Wait and take position slowly. See, candles are perfectly reversing here. See, slowly they are reversing here. This reversing is also an important thing. Okay, it will reverse from R1. See here, it will reverse from R1. After seeing the first two green candle, everybody will go for a long. But see, exactly at R1 it is reversing. So always remember, whenever there is a R1 previous day high and S1 previous day low, you should wait. There will be some kind of reversal. And see, market is totally inside previous day high and previous day low. See, totally inside previous day high and previous day low. So these are the days you should avoid trading, because market is weak. Market is weak. Yesterday you ate two plates. Okay. Today you are eating only one plate. Why? Because you are unable to eat. Same way, yesterday market was trending. Now today market is unable to break previous day high and low. Market is weak. Market is not having energy. See, market is not having energy to break any of the side. Market is weak. See, market is weak. Clear? So whenever market is inside previous day high low, you should be cautious. Okay. And this big bull breakout and big bear breakout, these are Bahubali candles. Big bear breakout and big bull breakout. Okay. These are These you should apply in 5 minutes chart, okay? And you should apply this properly. You should apply this properly, otherwise you will make mistakes. For example, every time you should not try to see for a big bull or big bear. Okay, see, this is a RTP. This is a RTP, continuous small doji candles. See, continuous from 9:25 to 10:15. From 9:25 to 10:15, continuous doji candles. Now it is broken by one single red candle. See, this is called as Bahubali candle. This is what I tell it as hero candle. Okay, it is breaking. Once again. Yeah. Sorry, I forgot to share the screen. So see on February 18. Okay, on February 18, the continuous doji candles from 9:25 to 10:15. Continuous doji candles are there. Okay, now one red candle is breaking the range. This one red candle is breaking the range. This is called as hero candle. Very simple. This is hero candle. And see, the trend market went down. Okay, this is what I call as Bahubali candle. Okay, the moment I tell Bahubali candle, don't expect very big red candles. This is also hero candle only. And of course, you can take this candle also. No wrong in it. See, this candle also you can take it as a Bahubali candle, because see, previous 3 hours. See, on previous day from 1 o'clock, from 1 o'clock to 3:30, market was in a steady sideways market. See, from 1 o'clock to 3:30, market was in a sideways market. Now this Bahubali candle is breaking. First candle is breaking. This is Bahubali candle. Okay, like this you have to observe. Even this also you can consider. See, the total day was taken by one single candle. See? The total day was taken by one single red candle, and that is a repetitive pattern, our favorite pattern. Yes, Kiran, correct. If red candle means downfall and vice versa. On 13 narrow CPR, on 13 Bahubali candle breakout. Okay, so many confirmations on 13 January. So like this we have to apply the Bahubali candles. Clear? Same way here also, see the entire total days range. The total days range was broken by a single red candle. A single red candle. So we can expect downtrend. So this is how we use Bahubali candles. Okay, that you have to practice. Okay, immediately you cannot identify Bahubali candle. You need some little practice. And this Dow theory is very important in 5 minutes chart. Okay, many people make mistakes while identifying a Dow theory. See, what is Dow theory? First of all, I will explain what is Dow theory. Okay, I will explain Dow theory in daily chart. After that, we can see in 5 minutes, so that you will understand better. What is Dow theory? Dow theory is very simple. Market will be giving higher high and higher low. This is called as Dow theory. Okay, see, this high will be 100 rupees and the next high will be 120 rupees and the very next high will be 140 rupees. Similarly, this low will be 90 rupees, this low will be 110 rupees and this low will be 130 rupees. So each and every time the high will be going up and the low also will be going up. This is called as Dow theory. Okay, like this, the market will be going up. And in a falling scenario, I'm sorry for not sharing the screen, I forgot. So in a Dow theory, what happens? Market will be going higher and high, like this. This will be 100, this will be 120, this will be 140, and this will be 90, this will be 110, and this will be 130. So each and every time market will be going higher and higher. This is called as Dow theory. Okay, and in a falling scenario, what happens? Market will be coming down like this. Okay, so this low will be 150, this low will be 130, and this low will be 110. Okay, and this low will be 140, this low will be 120, and this low will be 100. Like this, each and every time market will be going down. This is called as Dow theory. Now observe the Dow theory in Bank Nifty. See here, this is a high, market is coming down, it is going to a lower high, again it is coming down, it is going to a lower high, and again it is coming down. Okay, now this high has been broken. Okay, but market immediately came down. Okay, see, this is called Dow theory, a simple Dow theory. Lower high, yes, swing low. This is lower high and this is lower low. Clear? And see here, at present, what market is doing, from here market is going up, again it is coming down. When this swing high is broken, we can expect an uptrend. We can expect an uptrend. This is called as Dow theory. And this Dow theory has been formed beautifully in Bata India. See Bata India chart, weekly chart of Bata India. See here, this is a perfect Dow theory. See, it goes up, it comes down. It goes up, it comes down. Again, it goes up, it comes down. Again, it goes up, it comes down. Like this, it is going in a higher high. And the low is also going high. This is called as Dow theory. Okay, now we are going to apply this in 5 minutes chart. That is the real challenge. You can identify Dow theory easily in daily chart or weekly chart. Now we are going to apply this in 5 minutes chart. See Dow theory in February 20. Okay, see the low is here, the low is here, the low is here, and the moment it broke up, the market went up. Clear? You should be very speed. You should be thinking in a fraction of seconds. Only then you can take a good position. Okay. Each and every time the market was going in a higher pattern. See, it was going up. Okay. The moment this swing high is broken, we can go for a long. Okay. And later on, what happened? See, market started to fall. That is also very simple. See here, market was going down. This is lower high, okay, and here also lower high, okay, and it broke the low also. See, this is Dow theory. This is a little difficult for everybody to identify in 5 minutes chart. Okay, initially it will take a lot of experience. After that, you can apply it, and don't find Dow theory every day. Okay, don't try to find Dow theory every day, because you will end up in identifying a wrong Dow theory. See, every time the candle is going low. Okay, this is lower high, this is lower high. Okay, the moment this low is broken, you can go for short. Okay, after that there is no lower lows. Okay, now the market started to go up. See, this swing high is broken. Now the market is going up. This high is also broken. So this is called as Dow theory. Okay, so I guess everybody understood what is Dow theory. This is Dow theory. Every time the low is coming down. So we can anticipate a breakdown and we can take a quick position. This Dow theory you should apply for a very quick scalping. Remember, you should apply for very quick scalping. Okay, don't try to stay in the position for a long time. Don't try to stay in the position for a long time. You should book some quick profits. So finally, we are going to complete stock selection methodologies. See, this stock selection methodologies I will not be covering in depth. Okay. See, one thing you should understand: this strategy is completely new for you. Whatever we saw today, 20, 50, and 200, and CPR tricks, how to use CPR and moving averages together. Okay, these concepts are totally new for you. So first you have to practice these concepts in one stock. See, when all the 35 people are practicing this strategy in Bank Nifty, what happens? The learning curve gets decreased. The learning time period becomes decreased. So it will be easy for everybody to learn this strategy easily. Okay. For example, if one person is seeing TCS, if one person is seeing HCL, if one person is seeing Bank Nifty, one person seeing Nifty, one person seeing crude oil, okay, then each and everyone will be asking doubts. Crude oil is forming RTP, shall I go for a long? One person will ask. One person will ask, Reliance is forming 208 candles, shall I go for a short? One person will ask. And another person will ask, there is an RTP in Jubilant Foodworks, shall I go for a long? One person will ask, okay. And one person will ask, there is State Bank is having 20, 50 flat and zigzag. It is better to avoid. Is it correct or not? One person will ask. So, if each and every person is focusing on one stock, it will be really difficult for me to answer everybody. It will be difficult for me to answer everybody and everybody will be confused. So what I will suggest is you should apply these tricks in Bank Nifty first as a common instrument, okay, as a common script, okay, as a common script. What I will do, focus on Bank Nifty. Okay, you can apply this trick everywhere. You can apply this trick in Nifty, you can apply in stocks, you can apply in crude oil, you can apply in Forex, everywhere you can apply, but follow in Bank Nifty for 30 days. Okay, I am giving 30 days support, right? In this 30 days, I want everybody to focus on Bank Nifty, okay, so that everybody will be predicting perfectly. Everybody's prediction will be correct. After 30 days, if you are focusing on any stock, it will be easy for you to take a confident entry. Okay. So this stock selection methodology is only for selecting stocks after 30 days. Okay. The first 30 days you should follow in Bank Nifty only. The first 30 days you should follow in Bank Nifty the stock selection methodology for next 30 days. Okay. So for all these methods, I am giving scanners. For NR7 charting scanner is there, I will give you. For 2-day, inside day and inside day charting scanner is there, I will give you. For moving average breakout also charting scanner is there, I will give you. Okay. And narrow CPR, you all know how to identify a narrow CPR, right? You all know how to identify a narrow CPR. So you can easily identify a narrow CPR using bow copy. Video is available. Video is available. Soon I will post another video for selecting narrow CPR easily. Okay. So for all these things, I am having video in my YouTube channel. This trend line breakout is very effective method. Okay. This trend line breakout, NR7 means narrow range 7. Narrow range 7, you can Google it. That is a different concept. NR7 means narrow range 7. You can select stocks for trading. Okay. Trend line breakout is also a very good strategy. Okay. I have posted in my YouTube channel, so you can go and check it. Okay. These are the common stock selection methodologies. This is how I used to select stocks. Okay. See, you can select stocks based on any method. You can select stocks from TV channel. You can select stock from WhatsApp channel. Okay. You can see any Telegram channel. You can, your tips provider will give you any stock. Okay. You can select stocks from business line newspaper. Okay. So anywhere you can select the stock, but you apply our trick. Whichever stock you are selecting, you plot CPR and moving averages and check whether it is obeying our strategy. If it is obeying our strategy, then you can take the trade. Then you go for the trade. Okay, otherwise don't take. That is the important thing which I will tell you. Okay, and the final part, why traders are losing money. See, price action decision for entry, exit and stop loss, already I told you, Krishna Sagar. While teaching each and every concept, I told you, right, where you should enter, where you should keep your stop loss. Okay, for RTP, you should keep your stop loss below 20. Target is CPR, I told you. For 200-day moving average, I told you. I will see here. Okay, this price action trading decision for entry, exit and stop loss, I already told you everybody. While teaching RTP itself, I told where you should enter, where you should keep your stop loss, and then for 200 hate candles, you should keep your stop loss above 200 or below 200, I told, right? So this price action trading decision, I already told for everybody while teaching each and every concept itself. Okay, while trading in bank nifty options, how to keep stop loss. See, when you are trading in bank nifty options, okay, the stop loss you have to keep based on option chart. Okay, or you can keep a standard stop loss of 25 points in options. Okay, you can keep a standard stop loss of 25 points in options, and if you are trading in futures, you can keep a standard stop loss of 50 points in bank nifty futures. Okay, or even you can watch the options chart and you can keep the stop loss. Okay, initially what you do, you watch the market for 1 week. Okay, and you just observe how it is moving, how we can keep the stop loss. After you enter a trade, it will be easy for you. Okay, and understanding the candlestick psychology also we completed. Okay, what is the candlestick psychology? Okay, this Bahubali candles, repetitive patterns, Dow theory, these comes under candlestick psychology. And stock selection methodologies. Stock selection methodologies, I will not be covering in depth because I don't want everybody to focus on stocks. I want everybody to focus on bank nifty. Don't focus on stocks initially. Stock selection is very, very easy. You can even select stocks from pre-open market. You can even select stocks from top 10 gainers. You can select stocks which is having weekly breakout. You can select stocks from monthly breakout. There are several methods for stock selection, but keep it aside and focus on bank nifty. That is what I want you all to do. And finally, risk management and money management. This is what we are going to see now. Why traders are losing money in trading? The first thing is people don't know the trend. That is the real truth. For example, if I know market is going to go up, I will buy call option. If you know market is going to go up, you will buy call option. Everybody will buy call option, right? But we are unable to trade. Why? Because we don't know the trend. Many people, there are many people, okay, after seeing a big red candle, they will go for a short. After seeing a big green candle, they will go for a long. Okay, as soon as day high is broken, they will go for a long. As soon as day low is broken, they will go for a short. Like this, by seeing the candles itself, they will take decision, but they don't know the actual trend. Now, in this webinar, I have taught you how to observe the trend, how to analyze the trend. I have taught you. Okay, this railway track pattern I taught you. Okay, this 200 head candles you know how to trade. CPR, ascending, descending CPR also you know how to take the trade. So now you know how to identify a stock trend. Okay, now you know, now the perspective of watching the charts is totally different for you. Okay, and multitasking is the second most important thing which people are doing. These are the mistake done by the traders. What is multitasking? Watching 2-3 stocks at a single time. Watching 2-3 stocks on a single time is also a important mistake. See, initially don't do this, that is my point. Okay, initially don't do this. Okay, when you are experienced, when you are consistent, when you are consistently profitable, okay, when you become a pro trader, you can do everything. Okay, you can even sleep and trade. Okay, no problem. But in the initial stage, you are like a school student. Okay, initial stage, you focus on one stock. Okay, keep your predictions perfect. After that, you can do wonders. Okay, so many people are hearing music. Okay, many people are watching videos in YouTube and they are taking the trade. One of my friend, he used to watch cricket match and he used to take the trade. Okay, and many people watch news channels and they take the trade. Okay, so these are multitasking. Don't do like this. Okay, initially focus on bank nifty, observe bank nifty, and you master bank nifty. After that, you can do whatever you want. And position sizing is the important mistake done by the beginners. See, now I have taught you many strategies, right? Okay, as soon as you see an RTP, what you should do? You should practice with one lot. But what people will do, okay, this is an RTP, surely it will go up, surely it will go down, and immediately people will take 10 lots, 20 lots, 25 lots. Okay, and what happens? They cannot control their emotions. See, if you are trading with 1,000 quantities, the moment 2-3 points goes up or down, your mind will be affected. Your emotions is your emotions will influence you. But when you practice with one share, nothing will happen for you. Okay, when you practice with one share, when you practice with 10 shares, your emotions is balanced. You can balance your emotion. Even though you are practicing with 10 shares, if the company is going down by 10 points also, you will not worry, because you are in a loss of 10 rupee, 100 rupee only, right? Okay, but assume you are having 1,000 quantities, and if the company is going down by 10 points, you are in a loss of 10,000 rupees. Now you will cry. Okay, now you will feel, you will worry a lot. Okay, for 2 days you will not eat, for 2 days you will not sleep. Okay, so why you are taking that risk? Okay, so first you should know how to balance your emotion using your position. Okay, so first you take small position and try to balance your emotion. That is the very important thing, because we are playing with real money. Okay, if you are throwing the net and if you are doing fishing, no problem. Even if the net is lost, no problem for you. Okay, but what we are doing, we are throwing the fish and we are catching another fish. That is the very big risk. Okay, if you are throwing the net and if you are fishing, even if the net is lost, no problem, nothing is lost. But we are throwing the fish and we are catching a fish. If the fish is lost, then the next meal we have to be hungry only. We have to starve for the next meal. Similarly, we are throwing our money and we are trying to take another huge money. We are playing with money, so our emotions are involved. So try to balance your position. Take small position and try to balance your emotion. Keep your emotion under your control. That is very important thing. I always used to say, even if you have a little technical experience, little technical knowledge, that is enough. But you need a lot of trading experience. Okay, see, this is my risk management and money management. I advise you, everybody. Okay, see, you should risk only 2% per day. For example, if your capital is 1 lakh rupee, you should risk only 2% capital per day, which means 2,000 rupees. Okay, you should lose only 2,000 rupees for 1 day. Okay, let's assume you are taking 2 trades, then you can risk 1,000 rupee per trade. Okay, let's assume you are taking 2 trade, then you can risk 1000 rupees for one trade. Okay. Now in Bank Nifty options, you can keep 25 points as your stop loss. In Bank Nifty options, you can keep 25 points as your stop loss. Market lot for Bank Nifty is 20. So your total risk in rupees is 500 rupees. For one lot, you are risking 500 rupees. So for one trade, you can risk 1000 rupees, right? So now you can practice with two lots. Okay. Since your risk is 1000, you can place one more lot, that is two lots only you should trade. Clear? If you are placing more than two lots, and if you are asking me, I lost 6,000, I lost 12,000, definitely I will not help. Okay, I will not help definitely. Don't come for help. So if you are practicing with two lots and if you are asking me help, definitely I will guide you. Okay, if you are losing 10,000, 12,000, 20,000, and if you are coming to me, surely I will not help. Okay, so this is the risk management timetable for you. You should follow this. Okay, you should definitely follow this. And if you are in a loss continuously for 3 days, if you are losing 3 days, 6% of your capital is lost. After that, again, you should not trade for the next 3 trading days. Okay, stop trading for 3 trading days, refresh your mind, take a break. Okay, you all have to trust me. Okay, I will tell you one secret, you should trust me. Okay, take regular break from market. Take regular break from market, surely you will become a successful trader. Okay, take a break of 1 week. Okay, take a break of 10 days. Okay, even take a break of 1 month. Okay, okay, take a break and come back to market. Surely your mind will be fresh. Okay, you will have some new energy to learn new thing. Okay, so take break regularly. That is a secret which I will tell you. Okay, and when your total loss for 1 month becomes 10%, you should stop trading. Okay, because with 1 lakh capital, if you are losing 10,000 in a month, that is huge. Okay, so you have to stop trading for the entire month and you have to learn the concept again. Okay, you have to study again, or you practice with one share, or you practice with one share, two share, five share. Don't feel ashamed of it. Okay, nobody is going to peep into your screen. Okay, nobody is going to plug your laptop and going to see your contract note. Nobody will see you. Okay, so don't feel ashamed. Practice with 5 shares, practice with 10 shares. Okay, and because you are going to trade for lifetime, you are going to trade for lifetime, you are going to be in stock market for lifetime. Okay, so take time and practice slowly. Okay, if you are profitable, what you have to do, you have to take out the profits alone. Okay, your capital should be 1 lakh, take out your profits. Okay, don't reuse your capital, don't reuse your profits, don't reuse your profits, take out your profit, maintain the 1 lakh in your trading account. Okay, and maintain a trade journal. Trade journal is compulsory because trading is a business. Many people are using trading as a tool for making money. Okay, that is very awkward thing. Okay, you are coming to market for simply making money means definitely you will not make money. You should consider trading as a business. Let's see, you are, assume you are running a hotel business. Okay, you are running a hotel business. What are the things you will do? You will calculate how much vegetables you need. Okay, you will calculate how much employees you should appoint. Okay, you should calculate how much people will come in weekdays. You should calculate how much people will come on weekends. Okay, you should check which food is liked by the people more. Okay, if people like roti very much, you should cook roti more. Okay, if people doesn't like roti, you should cook roti very less. Okay, like this you should do some analysis, right? And you should open the hotel in a very peak of the city. If you are opening a hotel outside of the city, nobody will come. Okay, so if you are opening inside the city, many people will come. Like this, you are doing analysis, right? When you are doing a hotel business, you will do analysis like this. Similarly, trading is also a business. Okay, you have to monitor everything. Okay, which pattern is suitable for you, which instrument is suitable for you, okay, which time is suitable for you. Okay, and trading in mobile is the most awkward thing. Okay, trading in mobile is the most awkward thing. It doesn't show professionalism. Okay, it doesn't shows professionalism. Trading in mobile is like wearing a trouser and coming for a conference meeting. Just imagine and see, there is a round table conference in a MNC company. I am wearing trouser and banian and I am coming. Will it look good? No, right? Similarly, if you are trading in a mobile, it is most awkward thing because you cannot see a chart properly. You cannot see a chart properly because when you are going to do scalping in bank nifty. Okay, bank nifty is like a giant. Bank nifty moves 100 200 points every day. You need to be very fast. Okay, you need to do your analysis very quickly. Okay, you should book your profits very quickly. Okay, you should be very fast. If you are trading in mobile, it is not convenient. Okay, mobile is just only for chatting purposes. Okay, you can hear songs in mobile, you can hear time pass with your girlfriend or boyfriend in mobile, but trading is a business. You cannot do in a mobile properly. Okay, can you drive a car in mobile? No, right? You cannot drive a car using mobile. Similarly, you cannot trade in mobile. That is not a professionalism. Okay, respect trading. Okay, and trade properly. Use a laptop for trading. Okay, these are the small things you should do. Consider trading as a business. Okay, and do properly, and trading will be easy. 2-3 months you need to spend. You need to put hard work. Initially you will lose. Only if you are losing, then it means you are in the right track. If you are profitable every day, then it means you are doing something wrong. Okay, so you have to lose initially, but my word is lose very little. Don't lose 6,000 10,000 in a single trade. Lose slowly and learn from each and every losing trade. I will show you a sample contract, sample trading journal. Okay, see, this is a sample thing. Okay, this is not the exact format. Okay, this is not an exact format. This is a rough trading journal. If you want, you can edit this. I will send this contract. I will send this trading journal to everybody. After this webinar, I will send the material and I will send the trading journal, stock selection scanners, everything I will send to you. Okay, this is a sample trading journal where when you are entering, okay, at what time you are entering, what is your stop loss, what is your profit, okay, what is your cumulative profit, what is the reason for your entry, okay, reason for your entry, reason for your exit, lesson for the day. Like this is a sample trading journal. If you want, you can edit this as per your wish. I will send to you. Okay, but definitely you should maintain a trading journal. Okay, I will not ask for your trading journal. Okay, you keep and maintain it for yourself. Okay, you maintain trading journal for yourself. Okay, and this break even also I have given. How much stop loss you should keep? 25 points. Okay, for futures you should keep a stop loss of 50 points. Okay, and this net profit and loss after taxes you should enter after receiving the contract note. You will receive the contract note at the night or tomorrow or the next day morning. After seeing the contract note, you should enter the net profit and loss after taxes. Okay, so this is a sample trade journal. This is not the original format. This is a sample trading journal. This is enough. Okay, this is what I want to tell you. And see, this is one important thing. Okay, you just imagine you are going to take only 12 trades per year. Just imagine you are going to take 12 trades per year, and so you are going to trade only one trade per month. Just imagine. Okay. So you are allowed to take only one trade per month. Now, will you take this trade? You should think like this before taking each and every trade. Many people, what they are doing as a fund, they are taking buy position, as a game they are buying, as a game they are selling. Okay, simply they are doing for time pass. Okay, take it seriously. You are going to trade only one trade per month. Will you take that trade? Like that, you have to think each and every trade and take only the good trade. Okay, thinking to trade every day is also a disease. Many people are having a disease. Okay, they need to trade every day. They need to trade every day. There's a disease. Okay, and many people will sit in this computer from 9 o'clock to 10 o'clock, night to 10 o'clock. Morning 9 o'clock to night 9 o'clock, they will be sitting in the computer. That is also a disease. Okay, just look for your entry. When your target is done, just exit and refresh your mind. That's all, because emotions is involved. That is the main thing. Okay, we are not doing day job to sit comfortably in a AC room and to do our day job. This is not a day job. This is emotion. You are trading with 1 lakh, 2 lakh rupees. Okay, 1 lakh, 2 lakh rupees is not a easy thing to learn to earn. Okay, so real money is involved, real emotions is involved. So you have to be cautious. Take the trade carefully. Take less number of trades and increase your profitability. Whether you win or lose, try to maintain your trading capital as it is. For example, I told your trading capital should be 1 lakh rupee. Okay, you will be winning, you will be losing. Okay, no matter. But at the end of the month, try to maintain that 1 lakh. Okay, try to maintain that 1 lakh. Try to balance that 1 lakh. Okay, that itself is enough. You will be successful. Don't aim for a 10% return, 15% return, 20% return. Don't aim for that. Aim to balance your trading capital as it is. Okay, and take small profits and build up confidence and positivity. Initially, don't wait for target. Okay, I have told you for RTP, CPR is the target. Okay, and I told you our CPR will be CPR levels is a target. I told you, right? But initially, don't wait for target. Book some 500 rupees, 600 rupees profit and build some confidence. Okay, and after that you wait for target. Okay, don't wait for 50 points target, don't wait for 70 points target. Okay, take small profit and build the confidence. Okay, there are many people, there are many of my students. Okay, you might have all read my reviews, right? You might have all read my reviews. Okay, so whatever I tell people, follow. Okay, so that you will become a successful trader. Only for your goodness I am telling. Okay, even if you are losing 1 lakh rupees, nothing for me. Okay, nothing for me, but it is a painful thing for you. Okay, I don't want you to do that mistake. Okay, so build confidence by taking small profits. Okay, and try to play test match with market. Don't lose your wicket. Don't fight with the market. Okay, see, market is like a god. Okay, because it is giving you money, right? You will respect your profession, right? Okay, you might be working in a MNC company. Okay, you might like your job or you may not like your job, but that is giving you money, that is paying you monthly. Okay, you are getting a monthly salary of 50,000 or 1 lakh. Okay, that is your profession. You might be an engineer, you might be a doctor, you might be a CA aspirant. Okay, you might be any profession. Okay, that is giving you money, so you should respect that profession. Okay, will you fight with your profession? No, right? Will you fight with your company? Will you fight with your profession? No, right? Similarly, market is going to give you money. You should respect the market. Don't fight with the market. People are fighting with the market. That's the reason they are not successful. Okay, they are taking revenge trades. Okay, they are fighting with the market as if they are fighting with the person, as if they are fighting with the physical person. They are fighting with market, mentally they are fighting. Okay, so respect the market. Market is like a god. Can you tell where is god? Nobody can tell where is god, right? We nobody can tell where is god. Okay, we cannot. Market is like a god. Okay, you should respect. We don't know whether market is uh, really giving money or really giving loss to everybody. We don't know, but we have to respect market. Market is like a god. Okay, so this is what I want to tell you. Okay, so if you have any doubts you can tell me. So we have completed our session. Okay, so this is a favorite Bruce Lee quote which I want to tell, which I want to mention to you all. Okay, you have to practice one kick 10,000 times. Okay, you have to practice one kick 10,000 times. And this is another Vivekananda quote. Okay, take up one idea and practice it again and again. Okay, so it will lead you to success. So that's all. The session is completed.